Whoa. Okay. That makes so much sense. So, it's like they are forming a supergroup. Like when Robert Plant and Jimmy Page teamed up after Led Zeppelin? Except instead of rock stars, it's asset managers. But wait. If everyone's trying to get into private markets, isn't that going to drive up the prices of those assets? Doesn't that mean the returns won't be as high as they used to be? I mean, if a ton of new money comes flooding in, wouldn't it dilute the potential gains?
Excellent question. You are thinking like a true investor already. That is absolutely a risk. A very real one. It's called capital chasing returns. And it's a classic market phenomenon. When too much money piles into a specific asset class, prices get inflated and future returns diminish. Think about the dot-com bubble. Everyone wanted to invest in internet companies regardless of their fundamentals, which led to absurd valuations and an eventual crash. Private markets aren't immune to this. We've already seen evidence of it in certain areas like private credit where yields have come down as more funds enter that space. Blackstone has been very vocal about the need for more capital to deploy into attractive opportunities. They need that increased demand to justify their management fees and drive returns, right? This collaboration will undoubtedly accelerate that trend. However, and this is a big however, the firms are betting on their ability to identify and source unique high-quality investments that can still deliver alpha even in a crowded market. They'll be leveraging their global network's due diligence capabilities and deal-making expertise to find those hidden gems. It's like truffle hunting, you know? Everyone is looking for truffles, but the best hunters have trained pigs or dogs, and an innate sense of where to dig. These firms believe they are the skilled truffle hunters in this scenario. They're confident in their ability to find deals that others miss or are unwilling to pursue.
Okay, truffle hunting? I like that analogy. So it's a race to find those good investments before everyone else does, and prices get too high? And what about Vanguard? They're known for super low fees. How does that fit into this whole thing where Blackstone is, well, not exactly known for being the cheapest option?
You've hit on a key dynamic. That's where the brilliance of this alliance comes in. Vanguard brings the cost discipline and broad distribution network. They can essentially package these more complex, higher-fee private market strategies into something palatable for their massive retail investor base. Vanguard has been slowly dipping its toes into alternative investments for years, but they've always faced a challenge: how to offer those products at a price point that aligns with their low-cost ethos. This partnership allows them to do just that. Leverage Blackstone's expertise without having to build it from scratch and potentially sacrificing their fee structure. It's like this: let's say you want a custom-built suit, Blackstone's private market expertise. You could try to learn tailoring yourself, but it will take time, effort, and likely result in a subpar product. Or you could go to a reputable tailor who can deliver a perfect fit, but it's going to be expensive. Vanguard is essentially partnering with Blackstone as the master tailor while still maintaining its brand promise of value for money. They'll probably structure the fees in a way that blends Vanguard's low-cost indexing with a reasonable fee for the private market component managed by Blackstone. It's a delicate balancing act, but a smart one if they pull it off.
This is getting complicated. Okay, so lower fees through Vanguard, expertise from Wellington and Blackstone, but what about the risk? Private markets aren't exactly known for being liquid. If I invest in this, can I just easily sell my stake if I need to get cash quickly? Is it like investing in a house? You can't just magically turn it into cash overnight.
Excellent point. Liquidity is the Achilles heel of private markets. It is very much like owning a house. These investments are illiquid, meaning they're not easily bought or sold on a public exchange. Unlike stocks and bonds, you can't just click a button and get your money back if you need it. That's why these types of solutions are typically best suited for long-term investors with a high tolerance for risk and the ability to lock up their capital for several years. The firms will likely address this by structuring the products with periodic liquidity windows, opportunities to sell your stake at predefined intervals. But even then, there's no guarantee you'll find a buyer at a price you like. They might also incorporate features like secondary market access, where investors can attempt to sell their shares to other qualified buyers outside of the formal redemption periods. But again, that's not guaranteed liquidity either. It is something they need to address head-on in their communication with investors, because if they don't manage expectations properly, you could see a lot of unhappy clients when market conditions change and everyone suddenly wants out at once. It happened during the early days of non-traded REITs back in the 2000s, a cautionary tale about liquidity risk. They must learn from those mistakes. This whole thing is very exciting, but there are definitely pitfalls to avoid, and this is why I love digging into these things. It's never simple, is it?
Never. Haha. So basically, it's a sophisticated play for more assets, with some genuine benefits for investors if they understand the risks and can afford to be patient. It kind of feels like Wall Street is always finding new ways to repackage old ideas, just with fancier names and bigger marketing budgets. Is that cynical?
Not cynical at all, darling. That's remarkably astute. You've hit the nail on the head. It is often about repackaging. Finance is a surprisingly cyclical business. What goes around comes around. This push into private markets isn't entirely new. It echoes similar efforts from decades past. But, and this is important, the environment is different now. The low interest rate regime of the last decade encouraged investors to reach for yield in riskier assets like private equity. And with demographics shifting, a growing number of retirees needing income, the demand for alternative investments will likely remain strong. So while it's a repackaging to some extent, it's happening against a backdrop of genuine structural shifts. And the marketing budget? Oh honey, you have no idea. The amount of money these firms will spend on promoting this initiative will be astronomical. They'll be dangling promises of higher returns and diversification in front of everyone they can reach. But that's where your due diligence comes in, and why I always tell people to understand what they're investing in before handing over their hard-earned money. It's a wild world out there, my dear. A wild world indeed. And this collaboration, well, it's just the latest chapter in the ongoing saga of Wall Street. This could be titled The New Titans, Accessing the Illiquidity Premium. What do you think?
I love that title. The New Titans. Sounds like a Marvel movie or something. Alright, Emma. This has been incredibly insightful and slightly terrifying. Thanks for breaking it all down. Now I need to go read up on truffle hunting. Just in case.
Alright, welcome everyone to what I'm tentatively calling the Titans Align. When public meets private. Haha. Sounds like a superhero team-up, doesn't it? But seriously, this collaboration between Wellington Vanguard and Blackstone is huge asterisk. It's not just about three big firms shaking hands. It's a fundamental shift in how investment access is structured. We're talking about bridging the gap between what was traditionally available to pension funds and endowments, those really sophisticated investors, and making it accessible to your everyday investor through financial advisors. Now, you asked fantastic question. A very astute observation actually, about Vanguard specifically, and whether integrating Blackstone's typically higher fee private equity will clash with their whole ethos of low costs. That's the million-dollar question, isn't it? And it gets to something really core about how these firms operate and what they promise their investors. Vanguard was founded on this radical idea, revolutionary even, that investment management should be a utility, not a profit center. Jack Bogle, bless his soul, believed that costs eat returns, and he built Vanguard around minimizing those costs. They're investor-owned. You own a piece of Vanguard if you invest in their funds. That creates a really powerful alignment of interest. But private equity isn't cheap. Blackstone is phenomenal at what they do. They find undervalued assets, improve them, and sell them for a profit. But that takes expertise. It takes deal-making prowess, and all that comes at a price. Their fees are significantly higher than Vanguard's typical index fund expenses. So how does this square with Vanguard's commitment to low costs? It's a delicate balancing act, you see.
Wow. That is a really interesting point. I always thought of Vanguard as the champion of keep your costs down. So having Blackstone involved feels weird. Like pairing a super minimalist with someone who loves gold-plated everything, haha. So are they just hoping people will pay extra for potentially higher returns from private equity? Is that how it works? And what even is private equity again? I always hear about it, but I don't really understand it.
Haha, that's a brilliant analogy. The minimalists versus the gold-plated everything. You've hit on something right there. People are hoping for higher returns. That's the core allure of private equity. Public markets, stocks and bonds that anyone can buy and sell, have become incredibly efficient over time. Finding truly exceptional returns in those markets is tough. Private equity, however, it's about investing directly in companies that aren't publicly traded. Think of it like buying a piece of your local bakery instead of shares of Coca-Cola. You're getting in on the ground floor, potentially helping to grow the business, and sharing in the profits when and if it gets sold or goes public. Now, why does that require higher fees? Well, it's intensely labor-intensive. Blackstone isn't just buying a stock. They are actively involved in running these companies. They bring in their operational expertise, help with strategy, find efficiencies. It's like being a hands-on business owner, but on a much larger scale. It requires an army of analysts and consultants, and all that costs money. Think about fixing up a house to flip it, right? You have the purchase price, then the materials, the contractors, your time, lots of expenses involved before you even think about making a profit. Private equity is similar but on an industrial scale. It's also illiquid, meaning it's not easy to sell your investment quickly if you need cash. Unlike stocks which are traded daily, these investments can be tied up for years. That illiquidity should command a premium, a higher potential return to compensate you for the risk of being locked in.
Okay, so it's like more work, potentially bigger rewards, but also harder to get your money back out quickly? That makes sense. But wouldn't that make it only good for people with asterisks of money who don't need immediate access to their funds? Like, the really wealthy folks? I'm just trying to wrap my head around how this is supposed to help everyday investors. And what happens if Blackstone makes a bad investment? Does Vanguard's reputation get dragged down too? That seems risky.
Exactly. Historically, Private equity was largely the domain of institutional investors, pension funds, endowments, sovereign wealth funds, who could afford to tie up capital for long periods and weather potential losses. They had the scale and expertise to manage that risk effectively. But there's been a massive push in recent years to democratize access to these alternative investments. The idea is, if private equity can deliver superior returns, shouldn't more people have the opportunity to participate? Blackstone has already made strides in this direction with offerings for accredited investors, those who meet certain income and net worth requirements. This collaboration with Vanguard is the next logical step, bringing a curated selection of private equity investments to a broader audience through financial advisors. However, it's not going to be like simply buying shares of stock. It'll likely involve some sort of pooled investment vehicle, maybe a fund of funds or a multi-asset portfolio, that diversifies across multiple private equity deals to mitigate risk. And you are spot on about the reputation risk. That is a significant concern. Vanguard's brand is built on trust and transparency. If Blackstone makes a series of bad investments, it could erode that trust. It's why I suspect we'll see very careful selection of which private equity strategies get offered through this partnership. They won't just throw everything at the wall and see what sticks. It reminds me a bit of when Netflix started offering original content. They were known for simply streaming movies and TV shows from other studios, but then they took a huge gamble on creating their own shows like House of Cards. It paid off big time, but there was definitely risk involved. If House of Cards had flopped, it could have damaged Netflix's reputation.
Oh yeah! I remember everyone talking about House of Cards when it first came out. It felt so new and different at the time. So, you think Vanguard will be really picky about what Blackstone brings to the table? Like, a quality control check almost. And, is this partnership going to change how everyone invests? Will other big firms start doing similar things? Because it feels like a pretty big deal.
Absolutely. I think that quality control analogy is spot on. Vanguard has a fiduciary duty to its investors, meaning they have to act in their best interests. They won't simply rubber stamp Blackstone's offerings. There will be rigorous due diligence and a focus on selecting strategies that align with Vanguard's overall investment philosophy. Those strategies come with higher fees than their traditional products. And yes, I believe this will be a catalyst for change in the industry. We're already seeing other asset managers explore ways to offer alternative investments to retail investors. This partnership legitimizes the concept and sets a precedent. It signals that access to private markets is no longer solely for the ultra-wealthy. It's also important to remember why this is happening now. Interest rates have been high, valuations in public markets are stretched, and investors are looking for new sources of return. Private equity, with its potential for higher growth, becomes more attractive in that environment. It's a classic diversification play, adding an asset class that has low correlation to stocks and bonds. It's like diversifying your portfolio isn't just about different types of assets, but also different sources of return. You don't want all your eggs in one basket, or all your returns dependent on the same economic factors.
That makes so much sense. It's almost like investing used to be a really exclusive club, and now they're slowly opening the doors? So, if I was going to dip my toe into this world, what should I be looking out for as an average investor? Besides the higher fees, of course. Oh, and one more thing. You mentioned diversification earlier. Does that mean I shouldn't just go all in on private equity, even if it seems really promising?
Haha, excellent question. Yes, absolutely. Investing is becoming less of an exclusive club, a little bit at a time, and you are right to ask about what to look for as an average investor. First and foremost, understand your risk tolerance. Private equity is inherently riskier than investing in the stock market. You need to be comfortable with the possibility of losing money, especially in the short term. Second, pay attention to liquidity. Don't invest any money you might need access to within the next 5 to 10 years. This isn't a place for your emergency fund. Third, focus on diversification. As you rightly pointed out, do not go all in on private equity. A small allocation, perhaps 5% to 10% of your overall portfolio, can provide some potential upside without significantly increasing your risk. And finally, do your homework on the fund manager. Who is running this private equity strategy? What is their track record? What are their fees and expenses? Transparency is key. If you don't understand what you're investing in, steer clear. It's a bit like learning to cook a new cuisine. You wouldn't start by attempting a complicated 10-course meal, right? You'd start with something simple, learn the basic techniques, and gradually build your skills over time. Investing in private equity is similar. Start small, do your research, and don't be afraid to ask questions. This whole landscape shift is fascinating to watch unfold. It really is. I think this collaboration will mark a turning point in how people access investment opportunities for years to come. And who knows, perhaps we'll look back on 2025 as the year the Titans aligned and changed investing forever. Alright everyone, welcome to what I'm tentatively calling the Titans Align, a shifting landscape in asset management. Now this is a fascinating development. Wellington, Vanguard, and Blackstone joining forces. It's like seeing Godzilla, King Kong, and Rodan decide to team up. And honestly, it should send shivers down the spines of many smaller players in the asset management world. We're talking about three powerhouses, each with a distinct strength. Wellington's active management prowess, Vanguard's low-cost indexing dominance, and Blackstone's unrivaled access to private markets. This isn't just about creating another multi-asset fund. It's about fundamentally changing access historically truly diversified portfolios, including substantial allocations to private equity, infrastructure, real estate, things that deliver potentially higher returns, but are traditionally locked away for institutional investors, or simply unavailable to the average investor, or even most financial advisors. These three firms are trying to democratize that access. Now, you asked a fantastic question about how this impacts smaller asset managers. It's not pretty, frankly. They're facing an existential threat here. Think of it like this. You're a local bakery specializing in sourdough bread, and suddenly Walmart starts baking artisanal sourdough at scale with lower prices due to their economies of scale. You can still make excellent bread, but competing on price and distribution becomes incredibly difficult.
Whoa! Okay, that's intense. So, these three are basically building a super bakery for investments? I guess smaller firms don't have the same buying power or relationships to get those exclusive ingredients like private equity deals, right? It's like trying to compete with Amazon when you're running a small bookstore. You just can't match their infrastructure and reach.
Precisely. You hit the nail on the head. The ingredients are the access to those alternative asset classes, the private equity funds, the real estate deals, the infrastructure projects. Blackstone is the access point. They have the relationships, the due diligence capabilities, the sheer scale to negotiate favorable terms and identify promising opportunities. Wellington brings the sophistication in allocating capital across these different ingredients, and Vanguard ensures it can be packaged and delivered at a cost-effective price point. Smaller firms simply don't have the negotiating leverage with fund managers or the internal resources for extensive due diligence on private markets investments. It requires huge teams of specialists, and think about compliance costs. Navigating the regulatory landscape for these complex products is expensive. This collaboration allows them to pool those resources and spread the cost. I remember back in '98 when Schwab acquired US Trust. It was a similar move, consolidating wealth management expertise and expanding access to higher net worth services. But this Wellington Vanguard Blackstone alliance, it's on another level of scale.
Okay, so smaller firms are basically facing a triple threat. They can't compete on price, access, or asterisk resources. Is it game over for them? Are they all just gonna get swallowed up by the bigger guys? Like when Netflix came along and Blockbuster just vanished?
Haha, not necessarily game over, but they absolutely need to adapt or find a very specific niche to survive. Some strategies might include hyper-specialization, becoming the expert in a very narrow segment of the market, like sustainable investing in emerging markets, for example. Others might focus on providing highly personalized advice and financial planning services that these larger firms can't replicate efficiently. Think about those bespoke tailors who thrive even with H&M around. They offer something completely different. Another option is to partner with these giants rather than compete against them. Maybe a smaller firm develops a cutting-edge technology platform for analyzing alternative investments and licenses it to Wellington, Vanguard, or Blackstone. Collaboration can be key, right? The world of asset management isn't static, it's constantly evolving. Remember long-term capital management in '98, a highly sophisticated hedge fund leveraging massive amounts of debt that ultimately collapsed and nearly brought down the financial system. It showed us how even brilliant minds need risk management and diversification. A lesson these firms seem to be taking to heart with this alliance.
Wow, that sounds scary. So LTCM was like the opposite of what these three are trying to do. Instead of diversifying, they were hyper-focused and leveraged to the hilt. That's fascinating and terrifying. Okay, back to the smaller firms though. You mentioned specialization. Could some of them focus on things that these big guys aren't interested in? Like, I don't know, investing in vintage comic books?
Laughing. Now there's an idea. Absolutely. There's a market for everything. The point is to find something unique and valuable that differentiates you. Seriously though, we're seeing increased demand for impact investing, investments that generate social or environmental benefits alongside financial returns. That's one area where smaller firms can excel if they have a genuine commitment and expertise, or perhaps focusing on underserved markets, providing financial services to communities that are overlooked by larger institutions. But it's not just about finding a niche, it's also about embracing technology. Fintech is disrupting every aspect of the financial industry, and smaller asset managers need to leverage tools like AI and machine learning to improve their investment processes, reduce costs, and enhance client service. Think about Robinhood. It democratized access to stock trading by making it easy and affordable for anyone to invest. Smaller firms can use similar approaches to disrupt traditional wealth management models. It's a bit like the music industry actually. When streaming services like Spotify emerged, record labels were initially resistant, but eventually they had to adapt and embrace new distribution channels or risk becoming irrelevant. The same principle applies here.
Okay, I think I'm starting to get it. It's not necessarily about being asterisk better asterisk than the giants, but about being asterisk different asterisk. Finding a specific need that isn't being met, and filling that gap. And definitely using technology to your advantage. This is like the David versus Goliath story of finance. Except Goliath has 3 heads now?
Exactly. A very astute observation. It's not going to be easy, but it's far from impossible. The financial landscape is constantly shifting. Innovation is key, and adaptability will determine survival. And this alliance between Wellington, Vanguard, and Blackstone, that's a major shift. It forces everyone else to reevaluate their strategies and find their own path forward. A truly pivotal moment in asset management history. And maybe we should have called the podcast 3 Heads Are Better Than One, the new era of asset management. What do you think?
I love it. That's way catchier than just Titans Align. Haha. And yeah, it's a little scary for those smaller firms, but also exciting to see how they will adapt. This whole conversation has been super insightful. Thank you.
Oh, this is a juicy one. The big three, Wellington, Vanguard, and Blackstone, teaming up to democratize access to private markets? It's like opening Pandora's box with a really good financial advisor. I'm calling this episode Opening the Vault, Democratizing Private Markets, Boom, or Bust. Because that's exactly what we need to unpack here. Now the core of your question is spot on. Increasing access to private markets. Think private equity, infrastructure, real estate funds, for a broader investor base absolutely carries risk. For decades, these asset classes were largely reserved for institutional investors, pension funds, endowments, sovereign wealth funds, folks who could stomach illiquidity, and had the sophistication to understand the complexities. I remember back in the late 80s when junk bonds were all the rage. Everyone wanted a piece of Michael Milken's action. It was fantastic returns for a while. But then it all came crashing down when investors realized they didn't fully grasp the underlying risks. The fallout wasn't pretty. This feels different, but with echoes of that same dynamic. The beauty and curse of private markets is illiquidity. Unlike stocks which you can sell in seconds, these investments are locked up for years, often 7-10 years or even longer, and valuations aren't marked to market daily like public equities. You get updates quarterly, maybe, but it's not the same transparency. This means investors can't easily bail out when things turn south.
Whoa, hold on a sec. Okay, so stocks are like ordering takeout, quick and easy access. You can change your mind anytime. But private markets, that's like commissioning a portrait. It takes years and you're kind of stuck with it once the artist starts painting? That's actually a really good analogy. But if these firms, Wellington, Vanguard, Blackstone, they are huge. They wouldn't do this if it was super risky, right? Like, isn't part of their brand about protecting investors?
Haha. Excellent question. And that portrait analogy is gold. You're thinking like a true investor. And yes, these firms are behemoths with reputations to uphold. That's precisely why this collaboration is happening. They believe they can mitigate those risks and deliver value to a wider audience. But here's the thing. Reputation doesn't prevent market cycles. It doesn't stop bad deals from getting made, or economic downturns from hitting. What these firms are trying to do is package these investments in ways that are more accessible through pooled vehicles like interval funds, for example, which offer limited liquidity windows and provide better education to financial advisors. Blackstone has been particularly aggressive at this. They've been creating feeder funds aimed at high net worth individuals, making it easier for them to invest in Blackstone's private equity deals. Vanguard is bringing its low-cost expertise to the table, trying to make these options more affordable, and Wellington brings the long-term asset allocation know-how. However, even with all that sophistication, a wave of relatively unsophisticated investors, and let's be honest, many individual investors are less familiar with private markets than pension fund managers, pouring into illiquid assets could create problems.
Okay. So more people are getting access, but they might not know what they're signing up for? That sounds precarious. Is this like those meme stock situations from a few years ago, where everyone was just following the hype and didn't understand GameStop or AMC? Could there be like a domino effect if lots of people suddenly want to get their money out of these private investments at the same time?
Precisely. That meme stock comparison is spot on asterisk. It's similar herd behavior driven by fear of missing out, FOMO, or a misunderstanding of risk. Remember when everyone was rushing into NFTs? Similar vibe. And you are absolutely right to ask about the domino effect. This is what keeps regulators up at night. Frankly, if there's a market shock, say, a recession or a significant geopolitical event, and a lot of investors try to redeem their investments in these private funds simultaneously, it could be disastrous. These funds aren't designed for mass redemptions. They invest in things that take time to sell: buildings, companies, infrastructure projects. A fire sale of assets would depress prices further, potentially creating a downward spiral. This is the systemic risk we're talking about. Think of it like this. Imagine everyone suddenly deciding they want to sell their houses on the same day. The market would be flooded with supply, and prices would plummet, right? It's the same principle but scaled up to a much larger level.
Whoa. Okay, that is terrifying. So it sounds like these companies are trying to make it easier, but there's still a huge risk involved. What kind of investors are most asterisk likely to be affected by this? And do you think regulators will step in to prevent things from getting out of control?
That's the million-dollar question. The most vulnerable investors will be those who don't fully understand the risks, lack a long-term investment horizon, or have an inappropriate allocation to illiquid assets. We're talking about retail investors, individuals saving for retirement, maybe, who are persuaded by promises of higher returns without realizing that those returns come with significantly more risk and less access to their capital. There's also a potential issue with financial advisors. Many aren't adequately trained on private markets. They might be tempted to recommend these investments because they offer higher fees, which benefits the advisor but not necessarily because they're suitable for the client. Now, will regulators step in? Absolutely. The SEC is already scrutinizing this trend very closely. We've seen increased focus on disclosures and investor education around private funds. I suspect we'll see further regulations designed to protect investors and limit systemic risk. Maybe stricter suitability requirements for advisors recommending these products, or higher capital requirements for the funds themselves. It's a balancing act. You want innovation and access to potentially higher returns, but you also need to ensure that investors aren't being exposed to risks they don't understand. It reminds me of the early days of mutual funds. There was a lot of excitement, but also a lot of fraud and abuse until regulations caught up.
So it's like a controlled experiment? They're opening things up slowly, and regulators are watching to make sure everything doesn't explode. That actually makes me feel a little better. One last thing. What about the firms themselves? Does this collaboration benefit them financially? It seems like there's a lot of potential for increased fees and AUM, assets under management.
You are absolutely right to ask about incentives. This isn't purely altruistic. While these firms genuinely believe they can provide value, there's a significant financial benefit for all three involved. More assets under management mean higher fees, of course. Wellington and Vanguard get access to Blackstone's exclusive private market deals, which expands their investment offerings. Blackstone gets to tap into Wellington and Vanguard's massive distribution networks, reaching millions more potential investors. It's a win-win if it's managed responsibly. The danger is if the pursuit of scale leads to a lowering of standards or inadequate risk management. That's where things could go wrong. But honestly, I think these are sophisticated players who understand the stakes. They've seen market cycles before and they know the importance of protecting their reputations. This collaboration isn't inherently bad. It has the potential to be a positive development for investors. But it requires careful monitoring, robust regulation, and most importantly, informed, educated investors who understand what they're getting into. This is a story that will continue unfolding over the next few years, and I suspect we'll see some interesting twists and turns along the way. Alright, welcome everyone to what I'm tentatively calling the Titans Unite, Decoding the Wellington Vanguard and Blackstone Alliance. A bit clickbaity perhaps? Haha, but honestly, this is a big deal. We're talking about 3 investment giants, Wellington, Vanguard and Blackstone, teaming up. Now, on the surface, it sounds like a simple collaboration to offer more diverse investment options, right? But dig a little deeper, and you see a fundamental shift in how they're approaching the market, especially concerning private assets. And you hit on something critical with your question about alpha. Is active management truly generating value, or just reshuffling the deck? That's what we need to unpack. I remember back in the late 90s, everyone was chasing tech stocks, convinced they'd found a way to beat the market consistently. Then the bubble burst, and a lot of those alpha-generating strategies went up in smoke. It taught me a harsh lesson: true alpha is rare, and often fleeting.
Whoa, okay. That's a lot. 3 huge firms working together in private assets? I feel like I only ever hear about stocks and bonds. What even are private assets? Are those like buying a castle or something? And alpha, is that like the first letter of the Greek alphabet? Because I know my alphabet.
Chuckles. That's a fantastic question. No, not castles. Although, some funds invest in things like timberland and vineyards. So technically maybe a castle isn't entirely off the table. But generally, private assets are investments that aren't traded on public exchanges. Think private equity buying entire companies or pieces of them. Real estate is another big one. Not just REITs you can buy as stocks, but actually owning buildings and land. Infrastructure, bridges, toll roads, airports, even things like energy pipelines. Blackstone in particular has been a master of this space for decades. Now about alpha. You're right to connect it with the Greek alphabet. It's used in finance to represent excess return. If the market goes up 10%, and your investment goes up 15%, your alpha is 5%. Essentially, you've outperformed the benchmark. But here's where things get tricky. Someone else had to underperform for you to achieve that outperformance. That leads us back to the zero-sum game idea.
Okay. So private assets are like secret investments only big people can do. And alpha is bragging rights in the investment world. But if it's a zero-sum game, doesn't that mean someone always loses? That sounds kind of awful, like playing Monopoly and just trying to bankrupt everyone else.
You're hitting on a really important point. Is often a zero-sum game, particularly in actively managed public markets. For every winner, there's a loser, before costs, naturally. That's why index funds, pioneered by Vanguard, became so popular. They simply aim to match the market return, providing consistent returns with very low fees, eliminating that active management risk of underperformance. Now the argument for private assets is that they aren't necessarily zero-sum. You're creating value by improving a company, developing real estate or building infrastructure, adding something new to the economy. Think about it like this. You buy a rundown factory in Detroit and invest money in modernizing it, creating jobs and increasing production. That creates wealth for everyone involved. The workers, the community, your investors. It's not just taking from Peter to pay Paul, though admittedly, even with private assets there's still a degree of relative performance. Some funds will outperform others within that asset class.
Ooh, I get it. Like flipping houses? You buy a fixer-upper, make it better, and then sell it for more money. Everyone wins. Well, except maybe the previous owner who didn't fix it up. But still, there's new value created. So why are these 3 firms teaming up to bring this stuff to regular investors? It feels like they've been keeping it a secret for ages.
Excellent analogy with the house flipping. You're catching on quickly, and you're absolutely right about them. Keeping it a secret. Historically, access to these types of investments, private equity, infrastructure, etc., was largely limited to institutional investors like pension funds and endowments. They have the scale, the expertise, and the risk tolerance to handle these complex assets. But there's growing demand from individual investors who want diversification beyond stocks and bonds. Asterisk and asterisk, they're looking for potentially higher returns in a low interest rate environment. Blackstone has been at the forefront of opening up private markets to individuals with products like their BREIT fund, but even that had some challenges last year when redemptions were limited due to liquidity concerns. This partnership is about creating more robust, diversified solutions with a broader range of access points. Wellington's asset allocation expertise and Vanguard's low-cost distribution network are key pieces of the puzzle here. They can essentially package these complex investments in a way that's easier for financial advisors and ultimately individual investors to understand and access.
BREIT? What's that? And liquidity concerns? That sounds scary. Is it like when everyone tried to withdraw their money from the bank in It's a Wonderful Life? Because that was a disaster.
Laughing? Not quite as dramatic as A Wonderful Life. But you're onto something with the liquidity piece. BREIT, Blackstone Real Estate Income Trust, is a publicly traded REIT that invests in a diversified portfolio of private real estate assets. It became incredibly popular because it offered a relatively high dividend yield compared to other income-producing investments. However, when interest rates started rising, and investors wanted to access their cash, the fund had limited liquidity, meaning they couldn't easily sell off properties to meet all the redemption requests without taking significant losses. They ended up restricting withdrawals for a period of time, which created quite a stir. This is exactly why diversification and careful structuring are so crucial. You don't want to be overexposed to any single asset class or illiquid investment, and that's where this collaboration makes sense. Wellington can help with the overall portfolio construction, ensuring there's a balance between public and private assets, and Vanguard can bring their expertise in risk management and distribution.
Okay, so it's like they're building a super team to handle these tricky investments. That actually makes sense. But going back to Alpha again, is this whole thing just about chasing higher returns at the expense of everything else? Is there a responsible way to do private investing that isn't just about making a quick buck?
That's an excellent question. And it gets to the heart of my own investment philosophy. I think we've moved beyond simply chasing the highest possible returns at any cost. There's growing recognition and demand for sustainable investing, impact investing, and ESG considerations. Investors are increasingly looking for investments that align with their values and generate financial returns. And honestly, good long-term investment is fundamentally about building something durable not just flipping assets quickly. This alliance has the potential to do that, by fostering innovation in how these alternative assets are incorporated into portfolios. By broadening access and improving transparency, they can encourage more responsible investing practices. But it's going to require a commitment to due diligence, risk management, and a long-term perspective. It will also mean being honest about fees, which have historically been higher in the private market space, and making sure investors understand the risks involved. I think this collaboration is a step in that direction, but we need to watch closely how it unfolds. Alright everyone, welcome to what I'm tentatively calling Navigating the New Landscape When Titans Collide. Haha, sounds dramatic, doesn't it? But truly, this collaboration between Wellington, Vanguard and Blackstone is a bit of a seismic shift in how investment solutions are being structured. We're diving deep into an announcement that dropped just yesterday. These three giants are teaming up to bring more sophisticated multi-asset portfolios, mixing public and private investments, to a wider audience. Now I've seen a lot of cycles in my time, Through the dot-com boom and bust, the 2008 financial crisis, it all feels like yesterday. And what consistently rises to the top isn't chasing hot trends, but understanding how different asset classes work together.
Whoa, okay. That sounds complicated. Wellington, Vanguard, Blackstone. These are huge names. I've heard of Vanguard. My grandma uses them for her retirement. But what does it even mean to mix public and private investments? Is that like investing in companies versus investing in like a lemonade stand?
That's a fantastic analogy actually. It's asterisk of like that. Public markets are your easily traded stocks and bonds, things listed on the New York Stock Exchange for example. Anyone can buy shares of Apple or Microsoft. Private markets on the other hand are investments in companies that aren't publicly traded. Think private equity firms buying out a company, investing in real estate developments before they're open to the public, or funding venture capital startups. It's less liquid, harder to sell quickly without impacting the price, but potentially offers higher returns because you're taking on more risk and illiquidity.
Okay. So higher potential reward, but also more complicated. My brain is already starting to hurt a little. So why are these three companies teaming up now asterisk? It feels like they could all do this stuff individually, right?
Excellent question. You're thinking like an investor already. They absolutely could and they have been in their own ways. But this collaboration is about scale and reach. Wellington brings nearly a century of active management experience. They know how to pick investments. Vanguard is the undisputed king of low-cost index funds and has built a massive distribution network reaching millions of investors. And Blackstone, while Blackstone is private markets. They're the biggest player in that space globally, with over $1.1 trillion under management. Each one brings something unique to the table, and by combining their strengths, they can create solutions that are more comprehensive and accessible than any single firm could manage on its own.
Okay, I get the synergy thing now. Like Voltron? All these separate robots combine to form a super robot. But you mentioned accessibility. Is this for regular people like me? Or still just for billionaires? That's what always feels intimidating about private investments.
That's precisely the point. Traditionally, access to high-quality private market investments has been limited to institutional investors, pension funds, endowments, very wealthy individuals. This partnership aims to democratize that access, making it available to a broader range of investors through financial advisors. They want to provide solutions that can help people meet their retirement goals and build wealth over the long term. It's about offering diversification beyond just stocks and bonds, something that's become increasingly important in today's low-interest rate environment. When I started out in this business, private equity was almost entirely off limits to individual investors. Now it's slowly but surely becoming more mainstream.
That actually sounds really good. But, and there always is a but, isn't there? You brought up transparency earlier. Private markets aren't as regulated as public markets. How can we be sure these new products will show us what's really going on with our money? I don't want to invest in something and then find out it's all smoke and mirrors.
You are spot on to ask that, my dear. That is the million-dollar question, and you're right to be skeptical. Transparency is a major concern with private markets. Public companies have strict reporting requirements, quarterly earnings reports, detailed financial statements. Private companies, not so much. It's one of the reasons why I always tell people to understand exactly what they're investing in before handing over their money. This collaboration will need to address that head on. They'll have to find ways to provide investors with clear, concise information about the underlying investments, the risks involved, and the fees being charged. This is where the reputations of these three firms come into play. Wellington and Vanguard are known for their integrity and commitment to investor interests. Blackstone has been making strides in increasing transparency around its own private market offerings. They've started providing more detailed performance data and reporting.
So, it's like trust but verify? I still feel a little uneasy though. What kind of risks are we talking about beyond just the lack of information? Are there specific things to look out for?
Oh, absolutely. Several layers of risk. Illiquidity is big one. As we touched on, you can't just sell your investment when you need to, especially in a downturn. Valuation is also tricky. Unlike publicly traded stocks, which have a daily market price, private assets are valued based on appraisals and estimates. Those can be subjective and may not always reflect the true value. And then there's manager risk, relying on the expertise of the investment team to make good decisions. You're essentially trusting them with your money, so you need to do your due diligence and understand their track record. Right. Remember long-term capital management in the late 90s? A fund run by Nobel Prize-winning economists who thought they could exploit tiny price differences in global markets. They used massive leverage, borrowed a lot of money, and when things went wrong, it nearly brought down the entire financial system. That's an extreme example, but it illustrates the dangers of relying too heavily on complex strategies and unchecked risk-taking.
Whoa, that sounds terrifying. So basically, even with these big companies involved, investing in private markets still feels risky. Is it worth it then?
It can be very rewarding if you understand the risks and have a long-term investment horizon. Private equity, for example, has historically outperformed public equities over extended periods of time. But that outperformance comes with volatility. Private markets tend to be less stable than public markets. I always tell people, think about your portfolio like a well-balanced diet. You need a mix of different asset classes to stay healthy and resilient. Public stocks and bonds are the staples, providing stability and growth. Private markets can be considered the vitamins, adding extra potential returns but requiring careful monitoring and management. You know what this reminds me of? It's like when Netflix started streaming, everyone was used to Blockbuster and going to rent DVDs. Streaming seemed risky at first, right? No physical product, relying on your internet connection. But look at where we are now. Sometimes taking a leap into something new and different can pay off big time. This collaboration could be the beginning of a similar shift in how people access investment opportunities.
That's a great analogy. Okay. I think I'm starting to get my head around this. So, we wait and see what specific solutions they come up with, but it's definitely something to keep an eye on, especially the transparency part, and maybe start doing some research into private equity, just in case Netflix 2.0 is about to happen.
Exactly. Keep your eyes peeled, do your homework, and always remember what Warren Buffett says. The stock market is a device for transferring money from the impatient to the patient. Haha. And in this case, it's also about bridging the gap between public and private worlds. This alliance, if executed well, could truly reshape the investment landscape. And frankly, after all these years, I'm excited to see what unfolds.
Whoa! Okay, that chef analogy is asterisk perfect. Asterisk, I never thought about it like that. So, it's almost like they're creating a new menu item, the fusion dish, and trying to upsell everyone on it. Even if someone just wants spaghetti carbonara. Haha. But seriously, this sounds complicated. And you mentioned competing in asset classes. Does that mean Vanguard is going to start recommending Blackstone's private equity funds to their customers over, say, a similar public equity fund they offer themselves? That seems weird.
Exactly. You're catching on quickly. It could happen, subtly, through the way these solutions are presented and marketed. Now, let me tell you a little story that illustrates this kind of conflict, though not in this exact context. Back in the early 2000s, I was advising a family office, very wealthy, incredibly sophisticated investors. They used multiple investment banks for different services. One bank, let's call them Goldman Light, had a fantastic research team except when it came to recommending investments that competed with their own proprietary products. Suddenly, the research would become less enthusiastic, good, but not great kind of thing. It was painfully obvious they were steering clients toward what benefited them most. This collaboration has built-in safeguards. I'm sure there are compliance protocols galore, but those can be bent and stretched. Transparency is key here. Will these firms clearly disclose when a recommendation benefits one of their partners in this alliance? Will advisors have enough information to make truly independent judgments on behalf of their clients? That's what we need to watch for. It also raises questions about fiduciary duty, right? An advisor has a legal obligation to act in the best interests of their client, not the firms they represent. This collaboration could create scenarios where those obligations are blurred.
Okay, that Goldman Light story is asterisk wild asterisk. So basically, the research team was just biased. That's crazy. It sounds like you really have to know what you're doing and do your own digging as an investor. And this fiduciary duty thing, I keep hearing about it, but what does it actually asterisk mean asterisk for someone who is like me, just starting out with investing?
Oh, absolutely. You need to be a skeptical consumer of financial advice. Always question everything. Fiduciary duty is crucial. Think of it as the highest standard of care. A fiduciary, typically a registered investment advisor, legally has to put your interests first. They can't recommend something just because it earns them a higher commission or benefits their company. Now there are advisors who aren't fiduciaries, brokers for example, and they operate under a suitability standard. That means the investment only needs to be suitable for your situation. It doesn't have to be the best option. There's a huge difference. It's like getting medical advice. You want a doctor who will recommend the best treatment, not just one that pads their wallet or benefits their pharmaceutical buddies. This collaboration in theory, could lower costs and improve access to private markets for smaller investors. That's the positive side. But it also introduces layers of complexity and potential conflicts. It'll be fascinating to see how it plays out.
Oh wow. So suitability just means good enough, while fiduciary means the absolute best. That makes so much sense now. I always thought advisor meant everyone had your back, but that's clearly not true. Okay, new question. Private markets, you keep mentioning those. What even asterisk are asterisk they? And why are these big firms trying to get more people involved in them?
Excellent question. Private markets are investments that aren't traded on public exchanges like the New York Stock Exchange or NASDAQ. Think of things like private equity, buying and selling companies that aren't publicly listed, real estate directly held by investment funds, infrastructure projects like toll roads or renewable energy farms, venture capital funding for startups. You get the idea. Historically, these markets were only accessible to institutional investors, pension funds, endowments, wealthy family offices, the 1%. They require large minimum investments and are generally illiquid, meaning you can't easily sell them when you need cash. But there's a growing belief that private markets offer higher potential returns than public markets over the long term. Why? Because they aren't subject to the same daily volatility and short-term pressures as publicly traded stocks. They are less efficient, creating opportunities for skilled managers to generate alpha, basically outperformance. Haha. It's like finding a hidden gem before everyone else does. Blackstone has been leading the charge in democratizing access to private markets through products like their interval funds and business development companies (BDCs), and Vanguard and Wellington are now jumping on board, recognizing that there's significant demand from investors who want diversification beyond traditional stocks and bonds. However, accessibility doesn't equal suitability for everyone. You need a long time horizon and a high risk tolerance to comfortably invest in private markets.
Okay, so private markets are like the secret menu at a restaurant, higher potential rewards. But you gotta know someone to get access. And it's not something you can just easily cash out of if things go south. That makes sense. It sounds really risky though. I mean, what happens if Blackstone buys a company and it turns out to be a total flop? Do investors lose everything?
That's the million-dollar question, isn't it? Risk is inherent in any investment, especially private markets. Yes, there's the possibility of losing money, even significant amounts. The success of these investments depends heavily on the skill of the fund managers and their ability to identify undervalued companies or successful projects. Blackstone, for example, has a phenomenal track record, but past performance is never a guarantee of future results. You've heard that one before. And it's not like trading stocks where you can see the price fluctuate every second. Valuations in private markets are less frequent and more subjective. Plus, there are fees. Lots of them. Private equity funds typically charge a 2% management fee and take 20% of any profits above a certain hurdle rate. It's known as 2 and 20. These new investment solutions coming out of this collaboration will need to carefully balance the potential for higher returns with the increased risks and costs. The key is transparency, diversification, and understanding your own risk tolerance before diving in. It's a fascinating development, a real test of how these giants can truly serve the interests of all investors, not just their institutional clients. This could be a really transformative moment for the industry, or it could be a cautionary tale about conflicts of interest running rampant. We'll have to wait and see. Alright, welcome everyone to what I'm tentatively calling Decoding the Titans, when big money meets Main Street. Haha, a little clickbaity, I know. But it grabs attention, doesn't it? We're diving into this fascinating announcement, Wellington, Vanguard and Blackstone teaming up. Now this isn't just any collaboration, it's three absolute behemoths in the investment world joining forces to create, well, complex multi-asset solutions. And your question is spot on mind. Is there a risk that focusing on these intricate offerings prioritizes profit for the firms over genuinely serving individual investors? That's the million-dollar question, isn't it? You know, I remember back in the early 80s when defined benefit pension plans were really starting to shift towards 401ks. Everyone was talking about empowering individuals to take control of their retirement, which sounded great on paper. But what happened? Suddenly people were faced with a bewildering array of investment choices they didn't understand. Load funds, expense ratios, asset allocation. It was overwhelming. And guess who benefited most? The firms selling those products. So this feels familiar. The core issue here is access and complexity. These three firms are masters of institutional investing, managing money for pension funds, endowments, sovereign wealth funds. Their sweet spot isn't necessarily the average investor with $50,000 to their name. They're built for scale, for massive portfolios, and for sophisticated clients who understand what they're buying. The promise here is to democratize access to private markets, things like infrastructure, real estate, private equity, which historically have been out of reach for most individuals. But it's a tricky proposition.
Wow. The 80s. That feels so long ago. And you're right, that shift to 401ks was definitely confusing for a lot of people. My grandma still talks about how she just picked whatever fund had the prettiest brochure. So if these private markets are so amazing, and they sound like they could be, why haven't individual investors had access to them before? Is it just a matter of scale?
That's an excellent question. It is largely a matter of scale, but also regulation and structure. Private markets aren't as liquid as public markets, you see. You can sell your Apple stock anytime the market's open. But if you invest in a private equity fund that owns a chain of dental offices, you're locked in for years. There are limited opportunities to get your money out before the fund matures. That poses a problem for individual investors who might need access to their capital unexpectedly. Then there's the regulatory aspect. Selling these kinds of investments to individuals requires a lot more disclosure and suitability checks than selling, say, an S&P 500 index fund. It's more complicated for brokers to recommend them, and it opens up potential liability issues if things go wrong. The firms have traditionally steered clear because the costs of compliance outweighed the benefits for smaller investors. Blackstone in particular has been making a concerted effort to open up private markets. They've created vehicles designed specifically for individuals. But even those are typically only available through larger brokerage platforms or as part of managed accounts, which is, well, another layer of complexity. It's like trying to order a gourmet meal through a drive-through window. It's just not the natural way things are done.
Okay, so they're making it possible. But still complicated. And these solutions, multi-asset means lots of different things thrown together, right? Like stocks, bonds, real estate, and now private equity too. It sounds like a financial smoothie. But wouldn't that just create higher fees? I mean, each asset class has its own management fee plus the overall portfolio fee.
You're absolutely on it. Higher fees are always . The concern with these kinds of products, that's where Vanguard comes in, hopefully. They built their reputation on low-cost investing. Greg Davis mentioning their expertise in actively managed strategies and index funds at low cost is very intentional. They want to be seen as the price discipline within this alliance. Wellington has its strengths in active management and asset allocation, and Blackstone brings the private market access. But Vanguard's role is really about keeping those fees from spiraling out of control. However, and here's where it gets tricky, Even low fees can add up when you're dealing with complex structures. Imagine a layered cake. You have the base layer, maybe an index fund at 0.1%. Then you add a layer for active management at 0.5%, another layer for private equity at 1.5% or more. And then a fee on top of everything for coordinating it all. Before you know it, you're paying 2 to 3% annually. That may not sound like much, but over decades those fees can eat into your returns significantly. It reminds me of the story Peter Lynch told about two fund managers, one who charged high fees and consistently beat the market by a small margin, and another who charged low fees and matched the market's performance. Lynch argued that most investors would be better off with the lower fee option, because the higher fees eroded any potential benefit from the manager's supposed skill. It's simple math really, haha, but so many people ignore it.
That cake analogy is perfect. I can visualize it perfectly. And you mentioned skill. Does active management actually work asterisk? Because I hear so much debate about that. Some people swear by index funds and say nobody can consistently beat the market over the long term.
Oh, now that's asterisk, the holy grail of investing. You've hit on a hugely important point. The evidence is mixed, to put it mildly. Charlie Munger famously said that the key to investing is not to try and predict the future, and he was right. Over long periods, most active managers underperform their benchmarks after fees. It's incredibly difficult to consistently pick winning stocks or time the market. However, and this is a big however, active management isn't always bad. There are times when skilled managers can add value, particularly in less efficient markets like small-cap stocks or emerging markets. And private equity, well, that's where active management is almost essential. You need someone to identify promising companies, restructure them, and ultimately sell them for a profit. But even in private equity, success isn't guaranteed. Wellington has a long track record of successful active management. They have the resources to do deep fundamental research and make informed investment decisions. Vanguard also has some very impressive active teams, particularly on the fixed income side. The question is whether they can translate that skill into these multi-asset solutions without adding excessive costs or complexity for individual investors. This whole thing, it's a fascinating experiment. It's like they are trying to build a Formula One car and then sell it to someone who just wants to drive to the grocery store.
Laughing. That is asterisk. Exactly asterisk. What it feels like. A Formula One car to get groceries. Okay, so bottom line, it could be good if Vanguard keeps fees in check, but there's still a risk of overcomplicating things for regular investors.
Precisely. And that's why I think this announcement is worth watching very closely. We need to see the details of these solutions. What exactly will they offer? How much will they cost? And what level of education and support will be provided to investors? If they can deliver truly diversified portfolios with reasonable fees and transparent communication, then it could be a positive development for the industry. But if it ends up being another case of complex products benefiting the firms more than the individuals, well, history has a way of repeating itself, doesn't it? And remember what Warren Buffett says, risk comes from not knowing what you're doing. So investors need to understand exactly what they are getting into before they invest in anything, especially these new multi-asset solutions. This whole situation, it really highlights the enduring challenge of aligning the interests of Wall Street with the needs of Main Street, and it's a challenge that will likely continue for decades to come. So I think we can title this episode Decoding the Titans: Will Complex Investments Truly Benefit All? What do you think? Alright everyone, welcome to what I'm tentatively calling navigating the new landscape when titans collide in investing. A bit clickbaity perhaps? But seriously, today we're dissecting a fascinating development, this alliance between Wellington, Vanguard and Blackstone. It's a big deal folks. Asterisk. Really asterisk, big deal. We're talking about three of the biggest powerhouses in asset management joining forces to democratize access to, well, pretty sophisticated investment strategies. And you hit on something crucial right off the bat with that disclaimer, it's lengthy.
Whoa, okay. Democratization sounds good, but what exactly are these sophisticated investment strategies? I mean, I know Vanguard has those index funds everyone talks about, but Blackstone, isn't that like, for really rich people? And why are they all teaming up now? It feels a little sudden.
Excellent questions. You're already thinking critically, and that's fantastic. Okay, so let's break it down. For decades, truly decades, institutional investors, pension funds, endowments, these sorts of entities, they've had access to what we call alternative assets. Think private equity, buying whole companies, not just bits and pieces through the stock market, real estate directly, infrastructure projects like bridges and tunnels, even things like timberland or farmland. These investments can offer higher returns than traditional stocks and bonds because they're less correlated to the public markets.
Less correlated? Does that mean if the stock market is doing terribly, these other things might still be okay? Like diversifying your eggs into different baskets?
Precisely. A brilliant analogy. That's the core idea behind diversification, and alternatives take it to another level. The problem has always been access. These investments are illiquid, meaning you can't easily sell them for cash when you need to. They require a lot of capital to participate in, way more than most individual investors have lying around. And frankly, they're complex. Blackstone excels at finding and managing these alternative assets. Wellington is known for its incredible asset allocation expertise, figuring out what percentage of your portfolio should be in stocks, bonds, real estate, you name it. And Vanguard perfected the art of low-cost investing and making things accessible to everyone.
Okay, I'm starting to see how they complement each other. Blackstone finds cool investments. Wellington decides how much of each, and Vanguard makes it affordable. But still, that disclaimer. It's like a legal minefield. Potential could. Ugh.
You are spot on to focus on the disclaimer, my dear. That's where things get interesting. Those disclaimers aren't just boilerplate legal language. They are indicators. And a lengthy one like this signals a good degree of uncertainty. Now, it doesn't necessarily mean this collaboration is doomed, not at all. But it does tell you that there are significant hurdles to overcome in actually developing and implementing these new investment solutions.
What kind of hurdles? Like, technical stuff I won't understand? Or more like, will people even want these things? I mean, private equity sounds scary.
Both, actually. Technically, creating a product that can efficiently offer exposure to illiquid assets to retail investors is incredibly complex. You have to think about valuation. How do you determine the price of something that doesn't trade on an exchange? Liquidity. What happens if a lot of people want their money back at once? Regulatory compliance. The list goes on. And you're right to touch on demand. There's a perception problem with private equity and other alternatives. People associate them with risk complexity and high fees.
High fees? Ugh, that sounds awful. Vanguard is all about low fees. Will this mess that up? I thought they were the good guys fighting against everyone else charging like crazy amounts.
That's a very valid concern. And it's something Vanguard will be hyper-focused on, believe me. Greg Davis, their president, explicitly mentioned maintaining low costs in his statement. This is where the challenge lies. Blackstone manages high-fee assets traditionally. Wellington charges higher fees for its active management strategies too. Vanguard's role here isn't just about distribution, it's about driving down those costs and creating a product that aligns with their ethos. They will have to innovate on the fee structure, possibly using different share classes or tiered pricing models.
Tiered pricing, like first-class seats on an airplane. The more you pay, the better it is? Haha, that's kind of messed up for investing though, isn't it? Shouldn't everyone get a fair shake?
Laughing, a very astute observation. It shouldn't be quite asterisk like that in investing. But the principle is similar. Different levels of service or access might come with different costs. However, this collaboration aims for broader accessibility. Think about it like this. Remember when craft beer was only available at small breweries? Now you can find decent craft beers even at Walmart. That's what they're trying to do here. Take something previously exclusive and make it more widely available.
Okay, that makes sense. So, is there anything else the disclaimer might be hinting at, beyond the technical stuff, and keeping costs down? Because it really is asterisk long. It almost feels like they're saying, don't get your hopes up too much.
You know what? You're incredibly perceptive. The disclaimer also hints at potential integration challenges. These are three very different cultures, with different ways of doing things. Wellington is a private partnership, very collaborative, and long-term focused. Vanguard is investor-owned. Everything they do is ultimately for the benefit of their fund holders. Blackstone is a more aggressive, performance-driven firm. Getting these cultures to mesh seamlessly won't be easy. And there's always the risk that competing priorities or disagreements could derail the project.
Wow. Okay. So it's not just about building a new financial product. It's like a corporate marriage. That sounds stressful. I bet there are going to be lots of meetings and power struggles. It almost feels like Succession but with more spreadsheets. Haha.
Chuckles, you've hit the nail on the head, my dear. Is asterisk a bit like Succession with spreadsheets, but it's also an incredibly compelling story because if they succeed, and that's a big if, they could genuinely reshape the landscape of investing. They have the potential to unlock significant value for investors by providing access to opportunities that were previously out of reach, and maybe even give other firms some competition to do something similar. Alright everyone, welcome to what I'm tentatively calling the Titans Align. Will this alliance actually benefit Asterisk? You, Asterisk? Haha, a little clickbaity, yes, but it grabs attention. We're diving into this fascinating announcement, Wellington, Vanguard, and Blackstone teaming up. Now on the surface, it sounds fantastic. Three behemoths of the investment world joining forces to make sophisticated investments available to more people. But let's really dissect what that means. You know, I remember back in the early 80s when private equity was only for pension funds and endowments. The average investor? Forget about it. It was a completely closed shop. And then slowly things started to shift. We saw the rise of REITs offering real estate exposure, and later, hedge fund replication ETFs trying to capture that alpha. This alliance feels like another step in that direction, attempting to broaden access to private markets, which have historically outperformed public markets, but been largely inaccessible. Wellington bringing their active management expertise, Vanguard with their low-cost index strategies, Blackstone dominating the alternative asset space. It's a powerful combination, no question. They're each powerhouses in their own right. But will this really democratize access? That's the trillion-dollar question.
Wow, that's a great way to frame it. It does sound really promising, but I immediately wonder about the practicalities. Like, what even is a sophisticated investment in this context? And when they say democratize, are we talking about letting anyone with a Robinhood account invest? Or is this still geared towards people who already have a significant amount of capital? It feels like there's a big gap between the intention and the reality.
Excellent questions. You're thinking exactly as I would want an investor to think, skeptically optimistic, if that makes sense. Sophisticated investments in this case overwhelmingly refers to private assets, private equity, private credit, infrastructure, real estate held directly not through REITs. These are things that aren't traded on public exchanges. They're illiquid and traditionally require substantial minimum investments, often hundreds of thousands, even millions of dollars. Think about it like this. Buying a share of Apple stock is easy, anyone can do it. But trying to buy the whole apple orchard that's a different ballgame entirely, different level of complexity, different resources needed, and definitely a higher barrier to entry. And that's what private assets are like. They offer potential for higher returns because they aren't subject to the daily volatility of public markets. You're investing in the underlying business, not just the stock price. But you need scale and expertise to properly evaluate those investments. This alliance is hoping to create products, likely mutual funds or ETFs, that give access to a portfolio of these private assets, thereby lowering the individual investment minimums. However, even with lower minimums, there's still the issue of investor suitability. Private assets are illiquid, you can't just sell them quickly if you need cash. They also carry different risks than publicly traded stocks and bonds.
Okay, that makes sense about needing to buy a piece of the orchard instead of just an apple. So even if they create these funds with lower minimums, are they going to be realistically affordable for most people? I mean, Blackstone is known for managing money for really wealthy clients. It feels like their DNA is just geared towards high net worth individuals.
You hit the nail on the head there. That's a very perceptive point. Blackstone's bread and butter is institutions and ultra-high net worth families. Now they've been making efforts to expand access through products like their BREIT, a non-traded REIT, but even that has faced scrutiny regarding liquidity concerns and valuation challenges. They paused withdrawals from BREIT in late 2022 because of redemption requests exceeding available cash. It was a bit of a mess, honestly. The success of this alliance hinges on Vanguard's ability to leverage its scale and distribution network to reach a wider audience at a cost point that is reasonable. Vanguard has always been about accessibility for the everyday investor. They have millions of retail investors who trust their low-cost index funds. If Vanguard can wrap these private assets in a low-fee, easily accessible fund structure, then yes, it could genuinely move the needle. But if the fees are high, or the minimum investment is still substantial, it'll largely benefit institutions and high net worth individuals who already have access to these types of investments through other means.
Oh wow! I didn't know about that Brett situation. That's concerning. So basically, Blackstone has tried this before, but it wasn't exactly smooth sailing? This feels like a really complex puzzle with so many moving parts. Is there anything stopping these firms from just creating similar products on their own? Why do they need each other for this to work?
Excellent point. It's not a perfectly clean slate, is it? And you're right to question the necessity of the alliance. Each firm could theoretically develop similar solutions independently. Wellington already has private market capabilities, Vanguard is expanding its alternative offerings, and Blackstone obviously dominates that space. However, what this alliance brings is synergy. Think about it like making a really complex dish. You could try to do everything yourself, sourcing the ingredients, prepping them, cooking each component, or you could bring in experts for different parts of the process. Wellington's expertise in asset allocation and portfolio construction complements Vanguard's distribution prowess and cost efficiency, and Blackstone brings unparalleled access to private market deals. The marketing angle is also huge. Combining their brands creates a powerful message of trust and credibility, backed by 3 industry leaders carries a lot more weight than developed by insert firm name here. Plus they can potentially reduce costs through shared infrastructure and research efforts. It's all about creating something bigger and better together than they could achieve alone. It's like the Avengers assembling to fight Thanos. Each hero has their strengths, but it's the team that truly makes a difference. Haha.
That's a really good analogy. I get it now. So, it's not just about access to investments, it's also about brand trust and making something more appealing by combining forces. But what about the risks? Like if one of these firms messes up an investment, are the others liable? Or is each firm responsible for its own portion of the portfolio? This feels like a legal minefield.
You're right to be concerned about the legal complexities. It's certainly not a risk-free proposition. The structure of this alliance will be crucial. Based on what's been announced, it appears they are collaborating on development and distribution. But each firm remains legally responsible for its own investments and advice. They aren't forming some kind of super entity with joint liability. That would be a regulatory nightmare. However, there's reputational risk involved for all 3 firms. If one of them makes a bad investment decision that negatively impacts the overall performance of the solution, it could damage the reputations of all involved. It's like when a restaurant has a health code violation, even if it was just one chef making a mistake, the entire establishment suffers. And let's not forget regulatory scrutiny. The SEC is already paying close attention to how private assets are marketed and sold to retail investors. This alliance will likely attract even more oversight, especially given the size and influence of these firms. It's a delicate balancing act between innovation and investor protection.
Wow, this is way more complicated than I initially thought. So much potential upside, but also so many potential pitfalls. It's like watching a really high-stakes game of chess. Mang, I wonder if we will see other firms follow suit and start forming similar alliances.
That's a very astute observation. I absolutely believe this is the beginning of a trend. The industry is facing immense pressure to innovate, lower costs, and reach new investors. Standalone firms are finding it increasingly difficult to compete with the scale and resources of these larger players. We might see other combinations emerge, perhaps smaller asset managers partnering with technology companies or custodians to offer more comprehensive solutions. Think about the rise of fintech disrupting traditional finance. These alliances are a response to that disruption, an attempt by established players to leverage their strengths while adapting to the changing landscape. It's evolution in action. And remember, this isn't just about investment returns, it's also about attracting and retaining talent. The best minds want to work for firms that are at the forefront of innovation, and these alliances can create exciting opportunities for collaboration and growth. Honestly, it's a fascinating time to be an investor, or even just an observer. There's so much happening, so many new technologies emerging, and so much potential for disruption. It's like we're witnessing the birth of a new era in finance. And who knows, maybe one day even *U* will have access to investments that were once reserved for kings and queens, or at least very wealthy people.
That's incredibly exciting. And honestly, a little bit intimidating. But I feel like I actually understand this whole thing much better now. Thank you so much for breaking it down for me.
My pleasure entirely. Always happy to share my thoughts and hopefully shed some light on these complex issues. And remember folks, investing is a marathon, not a sprint. Do your research, ask questions, and always be skeptical, but also open-minded. Now, if you'll excuse me, I think I need a cup of tea and maybe a nice game of chess myself. This has been the Titans Align. Will this alliance actually benefit *U*? Alright folks, welcome to what I'm tentatively calling the Titans Align, navigating the new investment landscape. A little clickbaity perhaps. Haha, but seriously, this is a big deal. We're dissecting this alliance between Wellington, Vanguard and Blackstone, three behemoths in the investment world announced just last month. It's all about creating simplified multi-asset solutions that blend public ** and ** private markets. Now, on the surface, it sounds like a beautiful symphony of financial prowess. But as someone who's seen a few market cycles, and believe me, I have, I immediately started thinking about the underlying dynamics at play. It reminds me of a story my grandfather used to tell me about three very strong-willed farmers trying to build a barn together. Each had their own way of doing things, and it nearly ended in a feud over the placement of every single nail. So the question is, and you hit on it brilliantly, how sustainable is this collaboration long-term given their distinctly different cultures? And what kind of friction points might bubble up? It's not just about investment philosophies, it's about how these firms operate at their core.
Oh wow! That farmer analogy is perfect. Okay, so they all want to make more money for investors, right? I mean, that's the goal. But you're saying it's not that simple. Like, Vanguard has a different vibe than Blackstone? Because Blackstone seems flashier, maybe? I don't know. I'm still wrapping my head around what private markets even are.
Flashier is one way to put it. Haha, you're spot on. It is asterisk about more than just the end goal of returns. Vanguard, as you alluded to, is fundamentally investor-owned. That means their allegiance, legally and philosophically, is directly to their fund holders. Low costs, broad market access, those are paramount. Wellington, on the other hand, is a private partnership. They're owned by their employees, the investment professionals themselves. This fosters a long-term perspective, and a focus on research intensity, and nuanced active management. Think of it like a really exclusive club, where everyone genuinely loves talking about stocks all day. And then you have Blackstone, the king of alternative assets, private equity, real estate, infrastructure. They thrive on complexity and deal-making. They're in the business of building value within companies, often through significant operational changes. Now to answer your question about private markets, they are investments that aren't traded on a public exchange like the New York Stock Exchange. So things like investing directly in a company before it goes public, private equity, or buying up buildings and renting them out, real estate. It's less liquid, harder to quickly turn into cash, but can offer higher potential returns, but also comes with increased risk.
Okay, so Vanguard is all about we the people getting low-cost investments. Wellington is a bunch of smarty-pants stock pickers who like being independent, and Blackstone is like building empires. That's a very simplified way to look at it, but it's helping. But how do those three different approaches actually work together in practice? Wouldn't they constantly be disagreeing on what good investments even are?
Exactly. You hit the nail on the head. Disagreement is almost guaranteed, and that's where the friction will likely emerge. Haha. Imagine trying to blend a carefully curated wine collection, Wellington, with a mass-produced but affordable beverage, Vanguard, and then selling it alongside exclusive vintage spirits, Blackstone. They're catering to different palates. The key area of potential conflict is control. Wellington and Vanguard are accustomed to having significant autonomy over their investment processes. Blackstone, while collaborative, is used to driving the narrative when it comes to alternative investments. Will Wellington be comfortable ceding some control on asset allocation decisions to accommodate Blackstone's private market expertise? Will Vanguard be willing to accept slightly higher fees associated with accessing these illiquid assets, even if they believe the long-term returns justify them? These are delicate questions, and trust me, internal politics within firms like these can be intense. It's not always about right or wrong, it's about influence and power dynamics. You know what this reminds me of? The formation of the European Union. Lots of different nations with distinct interests trying to create a unified economic bloc. It works, mostly, but there are constant negotiations and compromises happening behind the scenes.
Oh my goodness. That's an amazing comparison. Okay, so it's like a financial EU, but is this whole thing just about getting more money from regular people? Because Blackstone seems really focused on individual investors in their press release. Is it a way to get us into things we shouldn't be in? Like, I feel like private equity is only for super rich people who can handle losing a lot of money.
That's an incredibly insightful question, and you're right to be skeptical. There is a democratization of finance happening here, and Blackstone is leading the charge with efforts to open up private markets to a wider audience. For years, these investments were largely restricted to institutional investors, pension funds, endowments, insurance companies, because of their complexity and illiquidity. However, there's a risk that this push for broader access could lead to individuals being exposed to products they don't fully understand or aren't adequately prepared for. Private equity in particular can be very volatile and requires a long-term investment horizon. You can't just easily sell your stake if you need the money. And those fees, they are significantly higher than traditional mutual funds. Now, Vanguard's involvement is crucial here. Their reputation for low costs and investor protection could help mitigate some of these risks, but it will require careful product design and transparent communication to ensure that investors understand what they're getting into. I would be looking closely at the fine print in whatever solutions they develop. It reminds me of when everyone was rushing into dot-com stocks in the late 90s. A lot of people got burned because they didn't fully grasp the risks involved.
Wow. Okay. That's scary. So it could be good, but also potentially really bad if not done right. Are there any specific things we should watch for as this unfolds? Like, what would be a red flag that this whole thing is starting to unravel?
Excellent question. Several things. First, keep an eye on the fee structure. If the combined solutions end up being significantly more expensive than comparable offerings from each firm individually, that's a major warning sign. Second, pay attention to liquidity provisions. How easy will it be for investors to access their money if they need it? Third, watch for conflicts of interest. Will Blackstone have an undue influence on investment decisions simply because they are the dominant player in the private market space? And perhaps most importantly, monitor how well these firms actually collaborate internally. Are they genuinely sharing knowledge and expertise? Or is it more of a marketing exercise where each firm continues to operate in its own silo? We'll see if this alliance fosters real innovation or simply becomes another example of corporate hubris. I'm reminded of the AOL Time Warner merger back in 2000. On paper it looked like a perfect match, combining a leading internet provider with a media giant, but the cultures were so fundamentally different that the integration was a disaster and ultimately led to massive losses for investors. This Wellington Vanguard Blackstone alliance could go either way. Brilliant synergy or spectacular failure, only time will tell, and honestly it's going to be fascinating to watch unfold.
Okay. I feel like I've learned so much. So basically, keep an eye on the fees, the liquidity, and whether they actually play well together, and maybe prepare for a potential financial EU meltdown. Haha. This is way more complicated than just picking stocks.
Laughing. You've got it. It's far more nuanced than simply choosing a good stock, that's for sure. And yes, be prepared for potential turbulence, but also recognize the opportunity here. If they can successfully navigate these challenges, this collaboration could truly transform how investors access and benefit from both public and private markets. I think we need to keep our eye on this one. It might just change everything. Welcome everyone to what I'm tentatively calling, and please tell me if you think it needs work, democratizing dollars, Blackstone, Vanguard, and the Great Portfolio Shift. It's a bit clickbaity, I know, but are talking about potentially huge changes in how everyday people invest. Now this news of Blackstone teaming up with Vanguard in Wellington, it's fascinating, isn't it? Because for years, the world of private equity has been frankly walled off. It's been a club, a very exclusive club, reserved for pension funds, endowments, sovereign wealth funds, and individuals who could write 7 or 8-figure checks. Now they want to open that up.
Whoa. Okay, that asterisk is asterisk a catchy title. Democratizing dollars. I like it. But Blackstone? Isn't that the firm that buys up everything? Like my friend's apartment building just got bought by them, and now her rent is going up. So why would I want to invest with them directly? That feels counterintuitive, you know?
Chuckles. A very fair question. And a very astute observation about your friend's situation. Blackstone does have a reputation for aggressive acquisition, and that's part of the reason this move is so interesting. They are incredibly skilled at finding undervalued assets, often distressed ones, turning them around and then selling them for a profit. That skill set, that's valuable, but traditionally it's only been accessible to those who can play the long game and afford the illiquidity. Now what does illiquid mean? It means you can't just sell your stake whenever you feel like it, like you could with a stock or bond. Think of it like investing in a beautiful antique clock. You might believe it will be worth a fortune someday, but if you need cash today finding a buyer willing to pay top dollar isn't easy.
Oh, okay. I get that. So it's not like clicking buy on Amazon and getting instant gratification. It's more planting a tree. You have to wait years to see the fruits of your labor, or in this case, profit.
Precisely, a brilliant analogy. Planting a tree is perfect. Now for decades, institutional investors, those pension funds I mentioned, they could handle that illiquidity, because their liabilities, meaning when they have to pay out money, are often far off in the future. They don't need instant access to cash, but everyday investors, most people can't tie up capital for 10 years or more. That's where this partnership comes in. Blackstone brings the deal-making expertise, Vanguard and Wellington bring the distribution network, and a history of serving individual investors, and the idea is to create these hybrid funds, part public market investments, like stocks and bonds that you can trade easily, and part private equity, offering potentially higher returns, but with less liquidity.
So it's kind of like diversifying your portfolio, even asterisk. More asterisk? Like, don't put all your eggs in one basket and don't just invest in things you can sell tomorrow? Is that what fully diversified portfolios means? But higher returns sounds risky. What about the volatility they mention with Trump's tariffs and stuff?
Exactly. Diversification is key. And yes, higher returns always comes with a degree of risk. That's just investing 101. Remember what old Ben Graham, Warren Buffett's mentor, said? The intelligent investor is a realist who sells into popularity and buys into unpopularity. These private equity funds aren't going to be without their bumps in the road. Absolutely. And that volatility they mentioned, that was then. This is now, but it's always lurking. The tariffs were just one example of how quickly things can change. Now we have geopolitical tensions with Russia and China. Interest rate hikes, it creates uncertainty. Private equity can be less correlated to the public markets, meaning when stocks are going down, private equity might hold up better, offering a cushion during those volatile times. But it's not foolproof. The key is understanding what you're getting into.
Okay, so less correlation. That makes sense. So if everything else tanks, maybe your fancy clock still has some value. That's good to know. But wait a minute. If everyone starts piling into private equity, won't the prices just go up and the returns come down? Like when everyone suddenly wanted Peloton bikes during the pandemic, the stock went crazy, and then it crashed. Isn't this the same thing?
Laughs. Oh my dear. That's a brilliant question. The Peloton example is perfect. That's what we call crowding. And you are absolutely right to be concerned about it. If suddenly everyone wants a piece of private equity, demand will drive up prices, potentially lowering future returns. Now Blackstone and Vanguard are hoping they can find enough good deals to offset that crowding effect. They'll have access to more opportunities than the average investor. But the risk is real. And that's why due diligence, careful research, is so important. Also, it's why these funds won't be for everyone. They will likely come with higher minimum investment requirements and a longer time horizon. It's not going to be like investing in an ETF through your Robinhood account, at least not initially.
So it's still kinda exclusive, just less so? Okay, I'm starting to get it, but why now? Why are they doing this asterisk? Now asterisk. Is it because interest rates are high and public markets are scary, so everyone's looking for somewhere else to put their money? It feels like a desperation move.
A very perceptive question again. You're hitting all the right notes. Yes. Partially it's about seeking higher returns in a low-yield environment. Interest rates are elevated and the stock market has been temperamental lately, to put it mildly. But I think there's something else at play too. Demographics. We have this massive wave of baby boomers retiring, a huge pool of capital that needs to find somewhere to generate income over the long term. Traditional 60/40 portfolios, 60% stocks and 40% bonds, aren't cutting it anymore, particularly with inflation eating away at purchasing power. They need something more. And private equity potentially offers that something more. Remember when I told you about Peter Lynch? He always said to invest in what you know. Well, these firms are leveraging their expertise to provide access to a market many investors simply couldn't reach before. It's about providing solutions for the evolving needs of investors.
That makes sense. The boomers need more oomph in their retirement accounts, and private equity might be that oomph. Okay. Wow. This is actually way more complicated than I thought it was. So basically, Blackstone isn't becoming a benevolent landlord, but they are trying to open up a previously exclusive club, and whether it's a good thing or not, depends on how carefully people look before they leap.
Smiling, you've captured the essence of it perfectly. It is complicated. And as always, there are winners and losers to be determined. But your instinct to question everything, especially when something sounds too good to be true, that's a quality that will serve you well in investing, and in life really. Now, I think we've definitely earned ourselves a cup of tea, haven't we? And maybe a discussion about the ethics of private equity firms buying up single-family homes, but that's a podcast for another day. Haha. Right. Welcome everyone to what I'm calling today the Great Shift. Private equity knocks on your door. Because that's precisely what's happening. We're talking about Blackstone, Vanguard and Wellington Management teaming up to bring private equity into the hands of everyday investors. Now this is a huge asterisk deal, honestly. For decades, private equity was strictly for institutions, pension funds, endowments, the ultra-wealthy. It was an exclusive club, but now, the doors are creaking open. And you know what makes it even more fascinating? This move isn't happening in a vacuum. It's unfolding as we're seeing volatility spike in public markets, thanks to things like, well, let's not forget the Trump tariffs. Remember those days? The market was doing the jitterbug every time he tweeted. It feels like history is repeating itself with some of the current geopolitical tensions. So the question becomes, amidst all this uncertainty, is this really a good idea for individual investors to dive into less liquid private markets? That's what we are going to discuss today.
Wow. Okay. That sounds intense. Exclusive club is right. I always thought private equity was something only Gordon Gekko did in movies. So, hold on. Let me get this straight. Public markets are bumpy because of, world events and trade wars, and the answer is to go into investments that are harder to sell. That feels counterintuitive, doesn't it? Like when your car breaks down, you don't buy a boat.
Haha, excellent analogy. You are absolutely right to question it. It does sound crazy on the surface. But here's the thing. And this is where understanding history matters. Think back to the post-financial crisis of '08. Everyone fled equities. They were terrified, and rightly so. Markets had plummeted. But those who understood long-term value, guys like Warren Buffett, Charlie Munger, they weren't selling, they were buying. Now, private equity isn't exactly the same as buying stocks when everyone is panicking, but there are similarities in thinking. Private equity offers diversification. It doesn't move perfectly in lockstep with the stock market and bonds. It can offer returns that aren't correlated to traditional assets. That correlation is key, you see. In times of public market turbulence, private equity can provide a cushion because its value isn't directly tied to daily stock fluctuations.
Okay, so it's like having different baskets for your eggs? So if one basket drops, the others might stay okay, but you said less liquid. What does that even mean? I feel like I need a finance dictionary right now. Is it like trying to sell a house in a bad market or something?
Exactly. Different baskets is a perfect way to put it, and yes, less liquid means it's not easy to turn these investments into cash quickly. Unlike stocks traded on an exchange, which you can usually buy or sell within seconds, private equity investments are, well, they're tied up for years. Think about investing in a small business. You don't expect to be able to cash out your share overnight. These funds often have lockup periods of 5-10 years, even longer. You're right to compare it to selling a house. You can't just press a button and get the money. You need a buyer, appraisals, legal paperwork. It takes time. That illiquidity is the trade-off for potentially higher returns. It's why private equity generally demands a premium, an illiquidity discount, as they call it. Let me think of another analogy. Imagine you're building a beautiful oak tree in your backyard. The seed represents your investment, and it takes years to grow into something substantial. You can't chop it down for quick cash every season, but with time and care it becomes incredibly valuable.
Ooh, I like the tree analogy. That makes sense. So you're saying these Blackstone Vanguard funds are trying to let regular people get in on that long-term tree growing potential? But wouldn't a normal person need a lot of money to even participate in private equity normally? Like yacht buying levels of wealth?
That's precisely the problem they're solving. Historically, yes. The minimum investment requirements were astronomical. You needed millions just to get your foot in the door. But these new hybrid funds aim to lower those barriers to entry. By blending private equity with more liquid public market assets, stocks and bonds, they can offer diversified portfolios with a smaller minimum investment. Think of it like this. Vanguard, being the king of low-cost index funds, brings their expertise in building broad diversified portfolios. Wellington Management contributes its experience in actively managing investments across various asset classes. And Blackstone, well, they bring the private equity magic access to deals and companies that aren't available on the public market. They're essentially creating a private equity light product for the masses. It won't be exactly like investing directly in a PE firm, but it will give individual investors some exposure to this asset class.
So it sounds smart, like a really clever way to democratize investing. But what about those Trump tariffs you mentioned? If things are already rocky with global trade and political stuff going on, isn't putting money into something locked up for 10 years even riskier? What if the oak tree gets struck by lightning?
Ah, a very astute question. That's exactly the heart of the debate. The timing is tricky. Volatility in public markets is always a concern and trade tensions definitely add to that risk. However, and this is where it gets interesting, private equity often focuses on companies with strong underlying fundamentals, businesses that are resilient even during economic downturns. They're looking for long-term value, not quick profits. And remember, these funds won't be 100% allocated to private equity. The blended approach, public and private, active and passive, is designed to mitigate risk. The public market portion of the portfolio can provide liquidity and stability. It's a balancing act. Plus, those tariffs, while disruptive in the short term, can also create opportunities for certain private equity investments. For example, companies that benefit from reshoring production or diversifying their supply chains could become attractive targets. It's about finding the right businesses to invest in, regardless of the macro environment.
Reshoring. Right. Bringing manufacturing back home because of tariffs. That makes sense. But is there a downside to everyone piling into private equity at once? Like, wouldn't that drive up prices and make it harder to find good deals? It's like when everyone wants the same limited edition sneakers. The price goes crazy.
Another excellent point. You are thinking like a pro. That's called dry powder, meaning there's a lot of capital sitting on the sidelines, waiting for investment opportunities. And yes, an influx of new money into private equity could inflate asset prices and make it harder to find undervalued companies. That's why experienced private equity firms like Blackstone are so crucial here. They have established networks and deal sourcing capabilities that give them access to exclusive investments. Their expertise in evaluating businesses and negotiating favorable terms is invaluable, especially in a crowded market. It's not just about having the money, it's about knowing where to put it. And let me tell you something, this whole situation reminds me of the dot-com bubble back in the late 90s. Everyone was throwing money at internet companies, regardless of their fundamentals. Then the bubble burst, and a lot of people lost everything. The lesson: due diligence is paramount. Investors need to understand what they're getting into before handing over their cash.
Okay, wow. That's a scary thought. The dot-com bubble was before my time, but I've definitely heard the stories. So basically, this new wave of private equity for regular people could be amazing, or it could turn into another sneaker hype situation if everyone isn't careful.
Exactly. It has the potential to be transformative, democratizing access to a powerful asset class. But it also comes with risks, illiquidity, higher fees, and the possibility of inflated valuations. The key is for investors to do their homework, understand their risk tolerance, and choose funds with experienced managers. This isn't a get-rich-quick scheme, it's a long-term investment strategy. And I think this alliance between Blackstone, Vanguard, and Wellington signals that they recognize those risks and are committed to providing access responsibly. At least, that's what they want you to believe. I always say, trust but verify. Always verify. That's the golden rule of investing. And with that, perhaps we should wrap up our discussion for today. Hopefully you all have a better understanding of this evolving landscape and can navigate it wisely. Welcome everyone to what I'm calling today, and don't roll your eyes, The Great Shuffle. When Wall Street giants play nice and why you should care. We're diving into this fascinating alliance between Blackstone, Vanguard, and Wellington Management, a move that's got the whole industry buzzing. And honestly, it's about time someone started seriously thinking about how to get these alternative investments, things like private equity, infrastructure, you name it, into the hands of everyday investors, not just the ultra-rich. Now the question on everyone's mind, and a very astute one at that, is whether this promise of higher returns is legitimate or just slick marketing designed to, well, let's say, line some pockets.
Whoa. Okay. That's intense right off the bat. Blackstone, Vanguard Asterisk, and Asterisk Wellington? That's like seeing Batman team up with Superman and Wonder Woman all at once. So these alternative investments you mentioned, are those super risky then? I mean, if they weren't, wouldn't everyone already be doing them? And higher returns? Sounds too good to be true, doesn't it?
Haha! Excellent analogy with the superheroes. At asterisk. A powerful combination. Now, let's tackle those risks first. Alternative investments. Absolutely asterisk. Can asterisk be riskier than your typical stocks and bonds? Think of it like this. Investing in Apple stock is relatively straightforward. You're buying into a publicly traded company with tons of reporting requirements and analysts scrutinizing every move. But investing in, say, a private equity firm that's buying up dental practices, that's far less transparent. You don't have daily price updates. It's harder to value what you own. And it's illiquid, meaning getting your money out can be a real headache. Remember the liquidity crisis back in March 2020 when everyone panicked about COVID? A lot of these alternative investments got frozen. People couldn't sell them even if they wanted to.
Frozen? Oh dear. So like, ice cream melting in the sun kind of frozen? That doesn't sound fun at all. So why would anyone willingly choose something that's harder to understand and hard to get out of? Is it just for the thrill? Because I definitely don't need any more thrills in my life right now.
Haha. Not exactly for the thrills. It's about potential returns. Historically, private equity and other alternatives have delivered higher returns than public markets. But with that added risk. Think of it like farming. Public stocks are like growing corn. Relatively easy, consistent yield, but price is dictated by a massive commodity market. Private equity is like cultivating rare orchids, more work, specialized knowledge required, much smaller scale, but the potential for selling those orchids to a collector, that could be lucrative. The catch? Not all orchids bloom.
Orchids. Okay, I'm following. So, it's about finding those special investment opportunities that aren't available to everyone else. But wouldn't that mean the really good ones are already snapped up by the big guys? Like if I suddenly decided I wanted to buy a Van Gogh painting, chances are someone else got there first.
Precisely. That's where this alliance comes in. Blackstone, with its immense scale and deal-making expertise, can access these opportunities. Vanguard and Wellington, with their massive distribution networks, they manage trillions of dollars for millions of investors, can then package those investments into funds accessible to a wider audience. They are essentially saying, hey, let's democratize access to private markets. It's a clever strategy, because it addresses a genuine need: diversification. Most people's portfolios are heavily weighted towards public stocks and bonds. Adding some alternatives, real estate, infrastructure, private credit, can reduce overall portfolio risk and potentially boost returns.
So it's like not putting all your eggs in one basket? I think my grandmother always said that. But if everyone starts piling into these alternative investments because they think they'll get higher returns, wouldn't the prices go up? And then the returns actually go down, like when Beanie Babies were all the rage back in the 90s?
Oh, you are sharp as a tack. You hit on a critical point. That's called asset-liability mismatch, or potentially creating an asset bubble. It is possible that increased demand drives up prices and compresses returns. This is why due diligence is paramount, and this is where the fee structure becomes crucial. Private equity fees are notoriously high, typically 2 and 20, which means 2% of assets under management annually, plus 20% of any profits above a certain hurdle rate. Now Vanguard is known for its low-cost funds. If they can negotiate lower fees on these blended products, it could significantly improve the value proposition for investors. That's where the marketing tactic piece comes in. Are these firms genuinely trying to deliver higher returns for their clients, or are they primarily focused on generating hefty fees for themselves?
Okay, so the fee structure is like the secret ingredient. If it's super expensive, then even if you get a little bit of extra return, it might not be worth it. That makes sense. But what about this volatility thing you mentioned earlier with Trump's tariffs? Does that have anything to do with all this? It sounds like a whole other tangled web.
You are asking the right questions. Absolutely. The timing is no coincidence. We were seeing increased volatility in public markets due to geopolitical uncertainty, trade wars, rising interest rates, inflation, you name it. Investors started looking for safe havens, something that wasn't directly correlated with the ups and downs of the stock market. Private assets generally are less volatile in the short term because they aren't marked to market daily like public stocks. However, and this is a big however, their value can be just as susceptible to economic shocks. It just takes longer for those effects to show up. It's not that private assets are immune to risk, it's that the risks are less immediately visible. Think of it like a slow-motion car crash versus a head-on collision. The outcome might be the same eventually, but you have more time to brace yourself or not.
Slow motion car crash. Wow, that's a vivid image. So, this whole thing is kind of about people getting nervous about the stock market and looking for something else? It feels like everyone's always chasing the next big thing. Remember Bitcoin when everyone thought they were going to be millionaires overnight?
Haha. Oh, you are hitting all the right notes. Yes, exactly. It's a classic case of investor psychology. When things are good, people get greedy. When things are bad, they get fearful. And this alliance is capitalizing on that fear, offering a perceived safe haven in turbulent times. Now, whether it will truly deliver on its promise, well, only time will tell. But I suspect we'll see more of these partnerships forming as the industry grapples with the challenges of a volatile market and a growing demand for alternative investments. And remember what Charlie Munger always said, it's not about how much you make, it's about how you keep it. So before jumping into any of these blended funds, do your homework, understand the fees, and assess your own risk tolerance. Because ultimately there's no free lunch on Wall Street. Welcome everyone to Decoding the Market Maze. Today we're diving deep into a fascinating development. This alliance between Blackstone, Vanguard, and Wellington Management. Now I'm calling this episode the Titans Tango. When private equity meets passive investing, a new era for your portfolio. It sounds dramatic, doesn't it? Haha. But truthfully, is quite significant. This isn't just some friendly handshake. It's a potential reshaping of how individual investors access alternative assets. Back in my day, and believe me, I have been around the block a few times. These firms operated in very distinct silos. Blackstone, the king of private equity, focused on illiquid, high-return opportunities that were typically reserved for institutions and the ultra-wealthy. Vanguard, well, they practically invented passive investing with those incredibly popular index funds, low-cost, broad market exposure. And Wellington, a solid long-term active manager. To see them collaborating like this, it's a bit of a head-scratcher at first glance, isn't it?
Wow, hold on! Blackstone. The guys who buy up everything? I always see their name in articles about huge real estate deals and stuff. And Vanguard is my grandma's go-to for retirement funds. That feels strange. Are they suddenly best friends now? It sounds a little like sharks and goldfish teaming up, honestly.
Haha, that's an excellent analogy. Sharks and goldfish indeed. But let's unpack this. You're right to be skeptical. The core philosophies are different. Vanguard champions passive investing. The idea that you can't consistently beat the market. So just own it all at a low cost. Blackstone? They absolutely believe skilled managers can find opportunities and generate alpha, returns above the market average, through active management of private investments. Now, Wellington sits somewhere in between. It is more on the side of active management, but has experience with passive investing as well, right? So why would these three titans join forces? Is it genuine collaboration, or a bit of strategic posturing? I lean towards the latter, being a significant component. Think about it this way. Vanguard and Wellington recognize that their traditional models are facing headwinds. Interest rates were incredibly low for a long period, making it harder to generate strong returns in public markets. And let's be honest, there's a growing demand from investors, especially those approaching or in retirement, for higher yields than bonds can currently offer.
Okay, I get that part. My uncle keeps complaining about how little his CDs are earning. But private equity? Isn't that super risky? What if Blackstone buys a bunch of failing shopping malls and everyone loses money? That's terrifying.
You're absolutely right to be concerned about risk, dear. Private equity is less liquid and inherently carries more risk than investing in the stock market. However, it also offers the potential for higher returns, and that's where this alliance becomes clever. By blending private assets with public ones, creating these hybrid funds as they call them, they're attempting to smooth out those risks. Think of it like making a smoothie. You add some blueberries, private equity for extra flavor and nutrients, but the base is still good old yogurt, public markets to keep things stable. It's about diversification, right? Not putting all your eggs in one very expensive illiquid basket. But I think this whole thing also speaks to the changing landscape of asset management. You see Apollo Global, KKR and Partners Group doing similar things, partnering with established firms like State Street and BlackRock. Everyone's trying to get a piece of that private market pie because it's growing exponentially.
Exponentially? Wow! Is that because everyone is just running out of ideas for where to invest in the regular stock market? I mean, everything feels so expensive right now. Even my friend's cousin who got super rich on meme stocks last year is starting to look worried. Haha!
Chuckles meme stocks. Oh dear, a fascinating blip in history. But you're touching on something important. Public market valuations are stretched in many areas, and with the uncertainty around interest rates, inflation, and geopolitical events, Trump's tariffs being a prime example mentioned in the article, investors are looking for alternatives that aren't directly correlated to those factors. Private equity, private credit, infrastructure. These asset classes can offer some protection during volatile times. Remember 2008, when the stock market was crashing? Many pension funds with significant allocations to real estate and infrastructure fared much better than those solely focused on public equities. It's a matter of diversification, and this alliance is about broadening access to those types of investments for more people. But I truly believe Vanguard sees it as a way to remain competitive. They're not abandoning their core principles, but they are acknowledging that investors need options beyond low-cost index funds.
So, you're saying it is partly about looking innovative? Like, hey, look at us. We're embracing the exciting world of private equity too, even if they don't fully believe in it. That sounds sneaky. Is that a bad thing?
Not necessarily bad, darling. It's business. Vanguard has a reputation to uphold, a commitment to delivering value to its investors. And increasingly, that means offering a wider range of investment solutions. They're not suddenly becoming Blackstone overnight. They're simply recognizing the potential benefits of incorporating private assets into well-diversified portfolios. And let's not forget the fees. Private equity firms charge higher management fees than traditional asset managers. This alliance could be a way for Vanguard and Wellington to tap into that revenue stream without completely compromising their low-cost ethos. They can offer these hybrid funds, collect those higher fees on the private portion, and still maintain their competitive advantage in the public markets. It's a win-win for them at least. We'll have to watch closely how this plays out for investors.
Oh wow. So it's like a really complicated chess game. I feel like I need a spreadsheet just to keep up with all these moving pieces. But it makes sense, right? Everyone wants a piece of the pie and is trying to position themselves for the future. This whole thing has given me a lot to think about. Thanks for breaking it down, Emma. It's been really insightful and slightly terrifying. Haha.
My pleasure, dear. Always happy to share my insights, gleaned from decades of watching these markets dance. And remember, knowledge is power in the investing world. Don't be afraid to ask questions. Do your research and understand what you're putting your money into. Now let's move on. I have a story about a very interesting investment I made back in 1987 during Black Monday. It involves a pickle factory and a surprisingly prescient observation about the snack food industry. Welcome everyone to what I'm tentatively calling Beyond the Stock Ticker, when private equity knocks on your door. Haha. A little dramatic perhaps, but seriously, this is a huge asterisk shift happening in the investment world. We're talking about Blackstone, Vanguard, Wellington Management, Titans, all of them, teaming up to bring private equity and other alternative investments directly to individual investors, even retirees. Now most folks think of investing as buying stocks and bonds on the market, but this is a whole different ballgame. Think of it like this. You're used to going to the grocery store for your fruits and vegetables. That's public markets, everything neatly priced and on display. Private equity is more like going directly to the farmer's field. You might get better quality, but it's harder to assess, and you're locked in a bit more.
Whoa, okay. That's a lot. Blackstone, Vanguard and Wellington. I know Vanguard from my mom's retirement account. Super safe, right? So, they're getting into the farmer's field now? What exactly are these alternative investments? Is that like investing in Beanie Babies again or something? Please tell me it's not Beanie Babies.
Laughing. No. Thankfully no Beanie Babies. Although, even those had a moment. These alternative investments primarily involve private equity, meaning owning pieces of companies that aren't publicly traded on the stock market. Think about buying into a local business with high growth potential, or investing in infrastructure projects like toll roads or renewable energy farms. It also includes things like private credit, lending money directly to businesses instead of buying their bonds. Now the appeal is higher returns. Public markets are pretty efficient. Everyone has access to the same information, so it's hard to consistently beat the market. Private equity can offer higher returns because you're getting in on something earlier, before it becomes mainstream. But that comes with a price.
Higher returns sound amazing. But what price? That farmer's field analogy is starting to worry me. Like, what if the farmer has a bad harvest and my investment just disappears? Is that possible? And why are they doing this specifically? I mean, hasn't private equity always been for institutions and really rich people?
Excellent questions. That bad harvest scenario is precisely where the risk lies. Unlike publicly traded companies, private investments are far less liquid, meaning it's much harder to sell them quickly if you need your money back, and valuations aren't as transparent. The price of a stock changes every second based on millions of transactions. A private equity investment might only be valued a few times a year, and those valuations can be subjective, let's say. As for why now? Several factors are at play. Firstly, public market volatility. Look at what the article mentions about Trump's tariffs causing swings in bond yields. Traditionally safe investments aren't so stable anymore. Investors are hungry for diversification and sources of return that aren't directly correlated to the stock market. Secondly, low interest rates for a long time meant returns on traditional fixed income were dismal. People needed alternatives. And finally, these firms, Blackstone, Vanguard, etc., are realizing there's enormous demand from individual investors who have been largely shut out of this asset class until now.
So it's like, people got scared with the stock market going up and down all over the place, and started looking for something safer that could also make them a lot more money. That sounds too good to be true. I remember my grandpa talking about the dot-com bubble. He lost a ton of money. Is this like that, but with private equity instead of internet companies?
Chuckles. You know your history. There are parallels. The dot-com boom was fueled by hype and speculation. This isn't quite as frenzied yet, but there's definitely a rush to get into private markets. And that leads directly to your initial question about regulation, which is the core of what we should be discussing today. Regulators are absolutely playing catch-up. The SEC, the Securities and Exchange Commission, has been increasing its scrutiny of private funds, but it's an uphill battle. Private equity firms aren't subject to the same reporting requirements as public companies. There's less transparency around fees, valuations, and potential conflicts of interest. Individual investors, unlike institutional ones, often don't have the sophisticated financial advisors or internal teams to properly assess these risks. It's like handing someone a complex engine manual and saying, "Here, fix this."
Oh no! That sounds terrifying. So basically, we're trusting these huge companies to not take advantage of regular people who don't really understand what's going on. That feels risky. Are they at least trying to explain things clearly? Like, do they have to tell you exactly how much it costs and what could go wrong? And if something does go wrong, is there anywhere for individuals to complain or get their money back?
That's the million-dollar question. The disclosures are improving, but they're still often dense and filled with jargon. Do asterisk have to disclose fees, but those fees can be incredibly complex. Management fees, performance fees, transaction fees. It adds up. And understanding the potential risks requires a real understanding of illiquidity, valuation uncertainty, and the specific industry you're investing in. Think about infrastructure funds, for example. They sound stable, right? But building a toll road takes years, and there are all sorts of things that can go wrong. Environmental regulations, political opposition, cost overruns. It's not like buying Apple stock. As for recourse, it's limited. Unlike stocks, where you have shareholder rights and potential lawsuits, if a company defrauds investors, it's much harder to pursue legal action in the private market. You are relying heavily on the fund manager acting in your best interest, which is why due diligence and transparency are crucial.
Wow, this sounds way more complicated than I thought. It's almost like they're counting on people being overwhelmed by all the information so they won't ask too many questions? Is that cynical of me? Haha, I saw this meme online once. It was a picture of a dog sitting in front of a computer with text saying, "I have no idea what I'm doing." That feels like how I feel right now.
Laughing, not at all cynical. There's definitely an information asymmetry here. It is designed to be complex, frankly. These are sophisticated products geared towards sophisticated investors. But the lines are blurring as these firms try to democratize access, and that's where regulation needs to evolve. We need clearer disclosure requirements, standardized valuation practices, and potentially even suitability standards, meaning advisors should only recommend these investments if they're appropriate for a client's risk tolerance and financial situation. The SEC is starting to look at this. They are proposing rules around the naming of funds, trying to prevent firms from marketing highly illiquid private funds as liquid alternative investments, which is misleading. But it's a slow process, and these firms have powerful lobbyists.
So, what should someone like me, just a regular person saving for retirement, should I just stick to boring old index funds and avoid all this private equity stuff altogether? Or is there a way to dip my toe in without getting totally burned? And what about Vanguard specifically? They always seem so trustworthy.
That's the smart question, isn't it? For most people, sticking with diversified low-cost index funds is still the best approach. It provides broad market exposure and minimizes risk. But if you're a sophisticated investor, understand your risk tolerance, have a long time horizon, and can afford to lose money, then a small allocation to private equity could potentially enhance returns. However, and this is crucial, do your homework, understand the specific fund strategy, the manager's track record, and all the associated fees, and be wary of anything that sounds too good to be true. As for Vanguard, they have a strong reputation for investor protection, but they're still motivated by profit like any other company. Their involvement in this alliance doesn't automatically make these investments safe, it just means they see an opportunity. They are entering into it cautiously, and with their emphasis on low cost. But remember, Even the most reputable farmers can have a bad harvest. The key is informed consent, knowing what you're getting into before you plant your seeds. Welcome everyone to what I'm tentatively calling the Great Shuffle. When Wall Street courts Main Street. Haha. A little dramatic perhaps, but honestly, is a massive shift happening right now, and we need to unpack it. Today we're dissecting this fascinating alliance between Blackstone, Vanguard, and Wellington Management. Three titans aiming to bring private equity into the hands of everyday investors. Now, you might be thinking, private equity, isn't that for ultra-rich folks in pinstripe suits? And historically you wouldn't be wrong. But things are changing, rapidly. This isn't just about giving more people access to potential higher returns, it's a fundamental reshaping of the investment landscape. I remember back in the late 80s, early 90s, the junk bond days, right? Michael Milken was king, and everyone thought they could get rich quick with high-yield debt. It felt similar then, a rush into less understood, less regulated markets. This feels different, but carries some echoes of that era. You see, access doesn't automatically equal understanding, and that's where the risks begin to pile up.
Whoa, okay. That sounds intense. So I understand Vanguard, they're the folks my mom uses for her retirement stuff, right? Super safe, index funds. But Blackstone, isn't that the firm that buys up everything? Like all those apartment buildings and hotels? So what exactly is private equity? In a way that doesn't make my eyes glaze over.
You're spot on about Vanguard, the epitome of low-cost passive investing. And you're also right about Blackstone. They are massive acquirers. They buy companies, real estate, all sorts of assets. Now private equity, in its simplest form, is investment in companies that aren't publicly traded on a stock exchange. Think of it like this: when you buy shares of Apple, you're buying a small piece of a public company. Private equity firms, however, buy entire companies, or large chunks of them, taking them private. They then work to improve the company, often through restructuring, cost-cutting, and strategic changes, with the goal of selling it later for a profit. It's not inherently bad. In fact, many excellent businesses have been strengthened by private equity ownership, but it's less transparent than public markets, which is why historically access has been limited to institutional investors, like pension funds, endowments, and very wealthy individuals. It's a world of long-term lockups. You can't easily sell your stake like you would with a stock, and complex valuation methods. It reminds me a bit of collecting rare stamps, only instead of stamps, it's businesses. You need to really know what you're doing.
Okay, that makes some sense. So if Blackstone is buying companies to fix them up and sell them for more money, why would Vanguard want in on that? Wouldn't that be a totally different strategy than just like owning the whole market with index funds? And what does Wellington even do? Is this some kind of supergroup of finance?
Wellington is another massive asset manager. They are known for their long-term investment approach and expertise in global markets. Now why Vanguard is getting involved? That's the key question, isn't it? They see a demand from their clients, your mom, and millions like her, for potentially higher returns than traditional stocks and bonds can offer. For years investors have been chasing yield. Interest rates were low for so long people needed to look elsewhere to grow their wealth. Private equity promises that potential, but it comes with added risk. Vanguard is recognizing they need to adapt to the changing market and provide a more complete solution. They're essentially saying, okay, we can offer our clients diversified portfolios that include private equity, managed by experts like Blackstone and Wellington. It's about offering access but also managing risk through diversification, spreading your bets around so you don't have all your eggs in one basket, right? Though adding a potentially bubbly asset class to the mix, well, we'll get back to that. This alliance is also a play for assets under management. The more money they manage, the more fees they collect. It's business after all.
Right. So it's like diversifying your snack drawer. You have chips and cookies and maybe some healthy stuff too, just in case. But you said something about bubbles earlier. Is this whole thing gonna blow up in our faces if everyone starts piling into private equity? And how would even know if a bubble is forming in that world, since it's not like the stock market where you can see prices changing all the time?
That's an excellent question. The snack drawer analogy works perfectly, haha. But yes, the risk of inflating asset bubbles is very real. You hit on something crucial: transparency. Public markets are relatively transparent. We have daily price discovery, regulatory filings, and analysts constantly scrutinizing companies. Private equity is opaque. Valuations are often based on estimates and appraisals, not constant market signals. And because it's less liquid, it's harder to buy and sell quickly. Bubbles can grow unchecked for longer periods before bursting. Think about real estate in the mid-2000s. Prices kept climbing, fueled by easy credit and speculation, but there was a disconnect between those inflated prices and underlying fundamentals. That bubble eventually burst spectacularly. Now, with increased access to private equity for retail investors, you have more capital flowing into these less regulated markets. The danger is that valuations become detached from reality, driven by hype and FOMO, fear of missing out rather than genuine value. It's like those Beanie Babies in the 90s, remember? Everyone thought they were going to be worth a fortune.
Oh my gosh. The Beanie Babies. My cousin made a killing for about 5 minutes. Okay. So if everything is so secret and hard to value, how can anyone tell if private equity firms are actually good at what they do? Are they really fixing up these companies or just flipping them around and hoping someone else pays more?
That's the million-dollar question. It's extremely difficult to assess performance in private equity. Public market metrics like price-to-earnings ratios don't apply directly. Instead, you look at things like internal rate of return (IRR), which measures the profitability of an investment over time. But even IRR can be manipulated or misleading, and there's a huge difference between gross returns, the total profits made by the fund, and net returns, what investors actually receive after fees are deducted, and those fees are substantial. Historically, it's been incredibly difficult for average investors to scrutinize these funds. They rely on the expertise of pension fund managers or endowment boards who have dedicated teams analyzing these investments. But now that this is opening up, there needs to be much greater scrutiny from regulators, increased transparency about fees and valuations, and a better understanding among individual investors about what they're getting into. This is where I see potential for significant problems if things aren't handled responsibly. The pressure to generate high returns will inevitably lead some firms to take on excessive risk or engage in questionable practices. We saw that during the financial crisis of 2008, remember? Leveraged buyouts went sour and nearly brought down entire financial institutions.
Wow. So it sounds like this could be really good really bad. It feels a lot more complicated than just picking stocks. Maybe I'll stick with my mom's Vanguard index funds for now. Is there any way to even prepare if you are thinking about dipping your toe into private equity? Like, what should people be looking for?
You're wise to proceed cautiously. Staying diversified and understanding the risks are paramount. If someone is considering investing in these blended funds, which will likely become more common, they need to do their homework. First, understand your own risk tolerance. Private equity is a long-term investment. You need to be comfortable with illiquidity and potential losses. Second, scrutinize the fees. They are typically much higher than those charged by mutual funds or ETFs. Third, look at the track record of the private equity firms involved. Have they consistently delivered strong returns over multiple economic cycles? And fourth, perhaps most importantly, understand what they're investing in. What sectors do they specialize in? What is their investment strategy? It's crucial to remember that past performance isn't necessarily indicative of future results, but it's a starting point. And finally, don't be afraid to ask questions. If you don't understand something, get clarification. It's your money after all. I always tell people, treat your investments like you would treat your garden, nurture them with knowledge, protect them from weeds, bad investments, and be patient for the fruits of your labor. And right now, this private equity landscape, well, it's looking a bit overgrown and needs some serious tending to. Welcome everyone to what I'm calling the Great Wealth Shift, or private markets the new kings. A bit dramatic perhaps, haha, but seriously, this news about Blackstone teaming up with Vanguard in Wellington is huge asterisk. It's not just about three big companies making a deal. It's about a fundamental shift in where people invest their money and who controls it. Now for those of you tuning in who aren't steeped in the world of high finance, and honestly most people aren't, and that's perfectly alright, let me break down what's happening. Traditionally, when you think about investing, you picture stocks, bonds, mutual funds, things traded on public exchanges. These are easily bought and sold, relatively transparent. But private assets, that's where Blackstone thrives, are different. Think private equity firms buying companies, real estate investments not available to the general public, infrastructure projects. These aren't as readily accessible or liquid.
Hold on a sec. So like if I wanted to invest in Blackstone directly before, that wasn't really an option for regular folks. It was more for institutions and super rich people?
Exactly. That's been the case for decades. These kinds of investments were largely reserved for pension funds, endowments, universities, foundations, and very high net worth individuals. The minimum investment amounts could be millions of dollars. But now, firms like Blackstone are actively trying to package these private assets into products that individual investors, people like you and me, well maybe not exactly anymore, haha, can access through their 401ks or IRAs. Vanguard and Wellington, being massive asset managers with millions of retail clients, provide the distribution network. It's a clever move.
So it's like taking something exclusive and making it less exclusive? Is that good? Because it sounds kinda sneaky somehow. Like they're opening up a velvet rope to everyone, but only after figuring out how to profit even more asterisk from it.
You're hitting on the core of the ethical question right there. That's precisely what this article is hinting at. It's not inherently bad mind you. Diversification, spreading your investments across different asset classes, is a cornerstone of sound financial planning. It reduces risk. And it's a big but private assets aren't like stocks and bonds. They are, by their very nature, less transparent and often have higher fees. Now let me tell you a story. Back in the 80s, I remember when real estate syndications were all the rage. Basically, groups of investors pooling money to buy property. Lots of promises of high returns, but also lots of hidden costs and conflicts of interest. Many people got burned. This feels similar.
Ooh, like a pyramid scheme-ish, but with buildings instead of, nothing?
Not quite a pyramid scheme, though the potential for abuse is definitely there. Think of it more like this. Blackstone and others are very skilled at finding valuable companies or assets, improving them, and then selling them for a profit. They're incredibly good at what they do, but their profits come from management fees and a share of the gains. When you add in layers of complexity, illiquidity, meaning you can't easily sell your investment, limited transparency, potentially high valuations, well, it becomes harder to know if you're truly getting a good deal.
Okay, so the diversification they're selling isn't really diversifying risk. As much as it's diversifying their own income streams. That's cynical, but I think you might be right. It just feels like they're capitalizing on people wanting better returns without fully understanding what they're getting into. Like when everyone was buying NFTs thinking they'd become millionaires overnight.
Precisely. And that ties directly back to your question about ethics. Is it ethical to market diversification, a concept built on risk reduction, through assets that actually concentrate power and wealth? Because let's be real, these private equity firms, they're not democratizing finance. They are concentrating control over large swaths of the economy, in the hands of a relatively small number of managers, and those managers have tremendous influence. Think about it. They own companies. They can influence policy. It's substantial power. It's almost like going back to the days of the robber barons, but with better marketing materials. Remember John D. Rockefeller and Standard Oil, controlling an entire industry? That's what we risk seeing replicated in various sectors through private equity dominance.
Wow. That asterisk is asterisk a little scary. So, if I'm just a regular person trying to save for retirement, should I be avoiding these kinds of funds altogether? Is it totally off limits, or is there some way to participate responsibly?
That's an excellent question. And the answer, as always, is it depends. A small allocation, and I mean asterisk small asterisk, perhaps 5% or less, to private assets within a well-diversified portfolio might be reasonable for someone with a long time horizon and a high risk tolerance. But you need to understand what you're getting into. Read the fine print, ask lots of questions about fees and liquidity, and don't invest more than you can afford to lose. Now this is where Vanguard coming on board makes things interesting. They have a reputation for low-cost investing and putting investors first. Their involvement could help ensure greater transparency and lower fees in these blended products, but it doesn't eliminate the inherent risks, of course.
Okay. So, like with everything else, do your research. I always feel like financial advice boils down to that. Ha ha. But seriously, this whole thing makes me think about how much control we really have over our own money. It's like a game where the rules are written by people who already have all the chips.
You've hit the nail on the head, and it's not just about individual investors. This shift towards private markets has broader implications for the economy as a whole. When companies are taken private, they're no longer subject to the same level of public scrutiny and accountability. Short-term profit maximization can take precedence over long-term value creation. It's a complex issue with no easy answers, but being aware of what's happening, asking these tough questions, that's the first step toward navigating this new landscape responsibly. And frankly, it's why I love talking about things like this. Keeps my brain sharp in retirement. Haha. Welcome everyone to what I'm tentatively calling the Great Shuffle. When safe bets feel unsafe. Haha, a bit dramatic perhaps, but stick with me. Today we're dissecting this fascinating alliance between Blackstone, Vanguard, and Wellington Management, a real power move in the investment world, wouldn't you say? It's about shaking up how everyday folks, especially those nearing or in retirement, access investments. For decades the advice was simple: stocks and bonds, diversify, ride it out. But now, things are shifting. This partnership is a direct response to that shift, and frankly it's been brewing for a while. We'll talk about why traditionally safe assets aren't feeling so safe anymore, and what this all means for your portfolio. I remember back in '98, the Russian default, everyone bolted for US Treasuries. They were the haven then. Now? Not quite so clear-cut.
Whoa, okay. That's a lot to take in right off the bat. Blackstone, Vanguard, Wellington. Those are huge names. I feel like I only ever hear about Vanguard when my grandma talks about her index funds, but private equity, isn't that super risky? Like things you can't easily sell if you need the money. And what does Trump's tariffs have to do with anything asterisk? Honestly, this is already making my head spin.
Chuckles warmly. Excellent questions. Absolutely excellent. You're right to be cautious about private equity. Traditionally it is riskier, less liquid, meaning harder to turn into cash quickly. Think of it like this. Buying shares in Apple is like owning a tiny piece of something everyone knows and trades every second. Buying into a private equity fund might be like investing in your neighbor's incredibly promising new bakery. Before it even opens, you believe in the idea, but there's more uncertainty. However, and this is key, that illiquidity comes with potential rewards. Private companies aren't subject to the same daily price swings as public markets. They can focus on long-term growth without worrying about quarterly earnings reports. This allows for potentially higher returns, but only if things go well, of course.
Okay, so it's a trade-off? More risk for a chance at more reward. But why are Vanguard and Wellington, who seem super conservative with their index funds, getting involved with Blackstone, which feels like the opposite of conservative? That just doesn't make sense to me. Is this like when my cat tries to befriend the vacuum cleaner?
Laughs heartily. A brilliant analogy. Your cat has excellent instincts. You've hit on the core of it. Vanguard and Wellington are traditionally known for low-cost passive investing index funds, as your grandmother wisely uses. But they're also realizing that relying solely on public markets isn't enough anymore, especially in this environment. And here's where things get interesting. Think about what's been happening with interest rates. For decades, bond yields were falling, meaning the return you got from lending money to governments or corporations was getting smaller and smaller. That made it harder for traditional 60/40 portfolios, 60% stocks, 40% bonds, to deliver the returns people need for retirement.
Hold on. So lower bond yields mean less money? It's like if I lend my friend $10 and they only give me back 8? That's terrible. But why would yields go down in the first place? Is someone secretly stealing from the bond market?
Smiling. No secret thieves, thankfully. Although that makes a good movie plot. It's about supply and demand. When investors are seeking safe places to park their money, like during times of economic uncertainty, the demand for bonds increases. That pushes up bond prices, and when bond prices go up, yields fall. Think about it like this. If everyone wants to buy a limited number of concert tickets, the price goes up. So with lower yields on bonds, investors need to look elsewhere for returns, and private equity becomes more attractive, even for giants like Vanguard. They're diversifying their offerings.
Oh, okay. I think I get it. Higher demand equals higher prices, but lower yield. It's counterintuitive. But you mentioned Trump's tariffs earlier. How do those fit into this whole mess? My uncle is a farmer, and he was asterisk, not asterisk, happy when all that started happening.
Ah, yes. Your uncle has good reason to be concerned. The tariffs, the taxes on imported goods, created a lot of uncertainty for businesses. They disrupted supply chains, raised costs for companies, generally made it harder to plan for the future. This led to volatility in the stock market. And when stocks become volatile, people start questioning whether they can rely on them as much. It's also important to remember that government bonds are often seen as a safe haven during times of economic stress. But if there's widespread uncertainty about trade policy and global growth, even they can become less reliable. We saw bond yields swing wildly precisely because of those fears. It was like watching a roller coaster, honestly. And that's where this alliance comes in. Blackstone specializes in navigating these complex markets, finding opportunities in private assets that aren't directly affected by the daily ups and downs of public trading.
So, it's like everyone is realizing they can't put all their eggs in one basket anymore. And these three companies are trying to create a super basket with different kinds of eggs. Some regular eggs from the store, public markets, and some fancy, free-range eggs from your neighbor's bakery, private equity.
Beaming precisely. That is asterisk exactly, asterisk, right? A super basket. Haha, you've got it. They are aiming for a more diversified portfolio that can withstand different economic conditions. The goal isn't necessarily to chase the highest possible returns, although they wouldn't complain about that, but rather to provide more stable, predictable outcomes for investors over the long term. And this isn't just happening with these three firms, Apollo KKR Partners Group. Everyone is getting in on the act because it's what clients are asking for. The demand for access to private markets is growing exponentially.
This is actually really interesting. So, should I be thinking about adding some of this private equity stuff to my portfolio? I mean, I'm still pretty young and have a long time until retirement, but it sounds like it could be a good way to boost returns. But also, scary.
That's an excellent question, and one that requires careful consideration. For someone younger, with a longer time horizon, a small allocation to private equity could make sense. However, you need to understand your own risk tolerance and be prepared for the fact that you might not be able to access those funds easily if you need the money in a hurry. There are now more accessible ways for individual investors to get exposure to private equity through things like interval funds or business development companies (BDCs), but it's still crucial to do your research and understand what you're getting into. Don't just jump on the bandwagon because everyone else is. Remember, in investing as in life, there are no guarantees, but diversifying intelligently can significantly improve your chances of success. And always remember that a little skepticism like yours is a very valuable asset. Welcome. Welcome everyone to what I'm tentatively calling the Great Blending Private Equities Push into Your Portfolio and what it means for you. Haha. A bit dramatic perhaps? But honestly, this news about Blackstone teaming up with Vanguard and Wellington is huge asterisk. It's a tectonic shift, really. We've been talking for years about the democratization of investing, right? Making sophisticated strategies available to more than just the ultra-wealthy. This feels like a major step in that direction. It used to be, if you wanted access to private equity, those juicy returns from unlisted companies, you needed to be an institutional investor, a pension fund, or have millions sitting around. Not anymore. These firms are actively building pathways for regular folks, well wealthy regular folks, let's be clear, but still, more accessible than ever before.
Wow. Okay. That sounds intense. So, Blackstone, isn't that the firm that buys up everything? I read an article about them buying all those warehouses, and then people complained about it on TikTok. So are they just trying to get even bigger by getting into everyday investors' hands? And what exactly does unlisted assets mean? Is that like companies that aren't on the stock market?
Chuckles. You're absolutely right about Blackstone's appetite. Jonathan Gray, their president, is a very clever man. They've built an empire buying up real estate, infrastructure, even data centers, all sorts of things you don't necessarily see on the stock market. Unlisted assets. You nailed it. Means companies that haven't had an IPO, aren't publicly traded. Think private businesses, venture capital investments, sometimes even things like direct lending to companies. They offer potentially higher returns, because there's less liquidity, and often more room for growth, but also significantly more risk. It reminds me of a story Warren Buffett told me once, actually, about how he passed on an early investment in Google. He said he understood the internet, but couldn't quite grasp how to value it properly. That's often the challenge with these less conventional investments. You need specialized knowledge to assess them accurately.
Oh my gosh. Warren Buffett. Okay, that's a name I recognize. But wait, if they're riskier, why would Vanguard, who always seemed so safe and focused on low-cost index funds, be getting involved? It feels like oil and water, you know? Like combining a meticulously organized spreadsheet with a Jackson Pollock painting.
That's a fantastic asterisk analogy actually. You've got a good head for this, right? Vanguard is the quintessential passive investor. They built their reputation on low-cost index funds that track the market, but Greg Davis, their CIO, is realizing that simply tracking the market isn't enough anymore, especially in this environment of potentially lower future returns and increased volatility. Remember what was mentioned in the article? The Trump tariffs creating wild swings in government bonds? Traditionally safe assets aren't so safe anymore, so Vanguard needs to offer something different to their clients. A way to boost returns without taking on excessive market risk, and that's where private equity comes in. Diversification, darling. It's the only free lunch in investing. They are trying to offer a one-stop shop for investors.
So they're hoping these unlisted assets will be like a cushion when the stock market crashes. Like having a secret stash of gold bullion hidden under your mattress? But wouldn't that mean you can't easily sell them if you need the money? I feel like this is where things get super complicated.
Exactly. You're hitting all the right points. Liquidity is the key issue here. Unlike stocks, which you can generally buy or sell relatively quickly, private equity investments are illiquid. It can take years to realize a return on your investment, and there's no guarantee you will get your money back, of course. That's where financial advisors come in, and this is the crux of our discussion today. Will they be equipped to navigate these complexities? Honestly, I have my doubts. Many advisors are trained primarily to deal with publicly traded securities, explaining concepts like capital calls, where investors are asked to contribute more money during the life of a fund, or carried interest, how private equity managers get paid. That's a whole different ballgame. It's like asking your family doctor to perform open heart surgery, you know? They might have some medical knowledge, but
Oh no. That sounds terrifying. So advisors are going to need serious training. Then, like sending them back to school for Private Equity 101. Maybe they could watch a bunch of Shark Tank's episodes? Is there even a certification for this kind of thing?
Laughing Shark Tank might be a start, but it's hardly comprehensive. There are some specialized certifications, like the Chartered Alternative Investment Analyst CAIA designation, but they aren't widely held. And let's face it, many advisors work for large brokerage firms that prioritize selling their own products, which often won't include these complex private funds. They need to be able to do proper due diligence, understand the fee structures, which can be exorbitant, and explain all this to clients in a way they can actually comprehend. Think about it. You have someone who's been diligently saving for retirement, expecting predictable returns from stocks and bonds, and suddenly their advisor is proposing they invest a chunk of their money in a venture capital fund that's developing the next generation of robotic dog walkers.
Robotic dog walkers? Okay. Now asterisk. That asterisk sounds like something out of a science fiction movie. But seriously, you're right. It could be really confusing for people. What if an advisor misrepresents the risks, or recommends a fund that's totally unsuitable for their client? That feels ethically questionable, to say the least.
Ethically questionable is putting it mildly. Absolutely, there's huge potential for conflicts of interest and outright fraud. Regulatory scrutiny will inevitably increase. The SEC will be watching these blended funds very closely, but ultimately the onus falls on investors to educate themselves and ask tough questions. Don't just blindly trust your advisors, do your homework. Understand the fees, the risks, and the underlying investments, and don't be afraid to walk away if something doesn't feel right. This is your retirement savings we're talking about. It isn't monopoly money, haha. It reminds me of a time when I was advising a very prominent family.
Oh, tell me. Is this a juicy story? Please say it's a juicy story.
Clears throat. Well, let's just say there was a rather heated debate about investing in a newfangled thing called .com companies back in the late 90s. The family patriarch, a very successful real estate developer, was convinced he could time the market and get rich quick. I advised caution, diversification, all the things you'd expect, but he insisted on pouring a significant portion of his fortune into these speculative tech stocks. Needless to say, when the bubble burst in 2000, he lost a tremendous amount of money. A painful lesson learned about the importance of prudence and understanding what you're investing in, and it highlights why this trend toward blended funds demands a whole new level of investor sophistication and advisor competence.
Oh wow, that's a really good cautionary tale. So basically, even if these funds could offer higher returns, they come with a lot more responsibility and potential for things to go wrong. It's like upgrading from a bicycle to a rocket ship. It might get you there faster, but you also need a whole new set of skills to pilot it.
Precisely. A rocket ship analogy is perfect, and frankly that's why I think we'll see a bifurcation in the financial advisory industry. Some advisors will embrace this complexity and become specialists in alternative investments. They'll invest in the training, build the expertise, and serve a niche clientele who can benefit from these strategies. But others, the vast majority, probably will stick to more traditional approaches, and that's perfectly fine. There's still plenty of room for good solid financial planning based on diversified portfolios of stocks and bonds. It just means investors need to be more discerning about who they choose to manage their money. This isn't the Wild West anymore. Well, It kind of feels like it sometimes, but hopefully increased regulation and investor awareness will keep things from getting too out of hand. Welcome everyone to what I like to call Decoding the Financial Frontier. Today's episode, which we'll tentatively title The Titans Unite, Blackstone, Vanguard and the Hunt for Higher Returns, is going to be a juicy one. We're diving into this fascinating alliance between Blackstone, Vanguard and Wellington Management, three absolute behemoths in the investment world. It feels like watching Godzilla team up with King Kong, and then asking them to manage your retirement account. Haha. Now you might be thinking, okay Emma, what does this even asterisk mean? Asterisk for us regular folks. Well, that's precisely what we're going to unpack today. This isn't just about big firms making deals, it's a signal of a massive shift in where and asterisk how asterisk people are investing.
Whoa! Godzilla and King Kong managing my retirement. That's intense. Okay, so these three companies are joining forces to offer investments to regular people. I thought Blackstone was all about big institutional investors, like pension funds and sovereign wealth funds. Aren't they usually too exclusive for the average investor?
Exactly. That's a brilliant observation. For decades, private equity, which is Blackstone's bread and butter, has been largely inaccessible to individual investors. Think of it like this. Traditionally, investing in a company meant buying stock on the public market, right? Everyone could participate. Private equity is different. It's about owning pieces of companies that aren't listed on any exchange. This used to be exclusively for institutions with deep pockets because you need a lot of capital. Remember the early days of Beanie Babies? Everyone thought they were going to make a fortune, but only the shrewd collectors, the institutional investors if you will, really capitalized on it.
Oh. Okay, I think I get it now. So private equity is like owning a secret piece of a company that nobody else knows about and then hoping it goes up in value. But what's the big appeal for Vanguard and Wellington? They seem pretty established with their mutual funds and everything.
That's the key question. And you're absolutely right to ask it. Vanguard and Wellington are incredibly successful doing what they do, offering low-cost, diversified public market investments. But, and this is a big but's, returns in the public markets have been, let's just say modest lately. The stock market has had its ups and downs, of course, but overall growth hasn't been as spectacular as it was in previous decades. Plus, we've seen increased volatility. Remember 2008-2020, even recently with the mini bank failures. People want something more. They're hungry for higher returns and diversification beyond stocks and bonds.
So they're looking at private equity as a way to boost returns. But isn't it riskier? I mean, if a company is privately held, you can't just sell your shares whenever you want, right? That sounds scary.
Precisely. You're picking up on the inherent trade-off. Private equity is generally riskier and less liquid, meaning it's harder to turn into cash quickly. But that's also where the potential for higher returns comes in. Think about it this way. If you buy a fixer-upper house, you take on more risk than buying something move-in ready. However, if you renovate it well, you can sell it for significantly more profit. That's the idea with private equity. Taking companies, improving them, and then eventually selling them, either to another company, or by taking them public through an IPO.
Okay, that makes sense. The fixer-upper analogy is perfect, but going back to my original question, does Blackstone really bring something new to the table? Wellington and Vanguard have been partners for decades. It feels like they could just figure out private equity on their own if they really wanted to.
That's a very astute point. A genuinely excellent question. And honestly, it's the million-dollar question everyone in the industry is asking themselves right now. Wellington has been quietly building its private market capabilities for years. They're not exactly newcomers, but Blackstone isn't just bringing expertise, they're bringing scale. They are, quite frankly, one of the largest and most successful alternative asset managers on the planet, managing hundreds of billions of dollars in private equity, real estate, infrastructure, you name it.
Hundreds of billions? Wow, that sounds like a lot of money. Like Scrooge McDuck swimming in gold coins kind of a lot?
Haha, you are not wrong. It is an astronomical amount, and that scale translates into access to deals, operational expertise, and a track record of successful investments that Wellington and Vanguard simply can't match on their own. Right now. Blackstone has the network, the relationships with companies, the teams on the ground who can actually improve these businesses. Think about it like this. You could theoretically learn to bake a perfect croissant yourself, but wouldn't you rather go to a world-renowned French bakery?
That's a good point. I definitely prefer getting my croissants from a professional. So Blackstone is the bakery in this scenario. But what about the timing of all this? It seems like it's happening at a time when things are uncertain, economically speaking. Is that just a coincidence?
Not at all. You're connecting dots here, which is fantastic. The current macroeconomic environment, low interest rates for a long time, recent rate hikes, geopolitical tensions, trade wars.
Okay, so it's a bit like diversifying your portfolio during turbulent times. Don't put all your eggs in one basket, right? I remember my grandmother always saying that, although she was talking about pickles, not stocks. She loved her pickled onions.
Haha. Your grandmother was a wise woman. The pickle principle applies to finance as well. Diversification is absolutely key. And this alliance is fundamentally about offering investors more diversification options. Now there's also the element of demographics at play here. We have an aging population, baby boomers retiring in droves, and they need income-generating assets to fund their retirements. Traditional pension plans aren't cutting it for many people anymore. They are looking for alternatives, and this is where these blended funds, a mix of public and private investments, come into play. It's about creating portfolios that can deliver sustainable returns over the long term, even in a volatile world. Welcome everyone to what I'm tentatively calling the Great Shuffle. When Wall Street courts Main Street. Haha. A bit dramatic perhaps, but honestly, that's precisely what's happening. We're seeing this fascinating shift. Blackstone, Vanguard, Wellington Management, these titans of finance, teaming up to bring private equity and other alternative investments directly to individual investors. Now you might be thinking, Emma, isn't that a bit risky? And you'd be right to ask. It is a big deal. For decades the really juicy returns, the kind that make headlines and fund lavish lifestyles, have largely been reserved for institutional investors, pension funds, endowments, sovereign wealth funds. Regular folks like us, we've mostly stuck with publicly traded stocks and bonds, reliable, transparent, but let's be honest, sometimes a little boring, and frankly returns haven't always kept pace with inflation, have they? This alliance is an attempt to change that. They want to blend public and private assets, think stocks and bonds alongside things like real estate, infrastructure projects, even venture capital, promising higher returns for the average investor. But it's not as simple as just adding a dash of alternative spice to your portfolio. It's more complex than making a souffle.
Whoa, okay. Hold on a second. Blackstone? Isn't that the firm known for buying up everything? Like, I read an article about them owning so many houses people can't afford to buy anymore, and now they want asterisk my asterisk money. This feels unsettling. Higher returns sounds good, obviously. But what does illiquid even mean in this context? Is it like trying to sell a vintage Beanie Baby collection?
Chuckles a very astute observation about Blackstone and their real estate holdings. You've done your homework, and the Beanie Baby analogy isn't far off actually. Illiquid essentially means you can't easily turn that investment into cash. Publicly traded stocks? Boom. Sell them on the exchange in seconds. Private equity? Not so much. Think about investing in a small business. Let's say your friend opens a bakery and asks you for funding. You believe in their sourdough dreams. But if you suddenly need that money back, you can't just call up the bakery exchange and sell your shares. That's the core trade-off here. Higher potential returns come with lower liquidity. And transparency? That's also a concern. Public companies have to file detailed reports with the SEC. We know exactly what's going on more or less. Private equity firms are, well, private. They don't share as much information. It's like comparing looking at the ingredients list on a box of cereal versus trying to guess the recipe for your grandmother's secret sauce.
Okay, so it's like trading convenience and knowing what you have for potentially bigger gains. That makes some sense? But wouldn't that also mean I need to be like asterisk really asterisk rich to even consider this? Like if my car breaks down, I can't just sell a piece of a private equity fund to cover the repair bill. It feels like it only suits people who have money to burn.
You're hitting on something incredibly important there. Accessibility. Traditionally, these types of investments were reserved for high net worth individuals and institutions precisely because they could afford to tie up their capital for extended periods. But that's changing. This new alliance and others like it with Apollo KKR Partners Group are trying to lower those barriers to entry. They're creating these hybrid funds designed to be accessible to a wider range of investors, even retirees saving for healthcare costs. However, and this is huge asterisk however, just because something becomes available doesn't mean it's right for everyone. It requires understanding the risks, having a long-term investment horizon, think 10 years or more, and being able to stomach potential volatility. Remember the dot-com bubble? People lost fortunes chasing those high-growth tech stocks. Private equity can be just as susceptible to downturns, and you won't have the same easy exit strategy.
Okay, so it's like they're trying to democratize access to risky investments? That sounds almost paradoxical. And what about these tariff blitz things mentioned in the article? How does that play into all of this? It feels a bit random.
Excellent question. You're picking up on the underlying context brilliantly. The mention of tariffs and market volatility isn't accidental. When public markets are unstable, like during Trump's trade wars or periods of economic uncertainty, investors often look for alternative sources of returns that aren't directly correlated to stocks and bonds. Private equity, real estate, infrastructure, these can offer some diversification benefits. Think of it like this. If you only eat one type of food, say apples, and there's an apple blight, you're in trouble. But if you have a varied diet, apples, bananas, oranges, broccoli, you're better protected against any single crop failure. The idea is to build a portfolio that can weather different economic storms, and frankly, with interest rates being so low for so long, investors have been desperate for yield, meaning returns on their investments. This desperation has fueled the demand for alternative assets.
Alright, I'm starting to see the big picture. So it's a combination of wanting higher returns, diversifying away from scary stock market dips, just plain old needing more money because interest rates were terrible? Is there a downside to Asterisk Vanguard, Asterisk being involved in this? They always seemed like the good guys, the champions of low-cost index funds.
That's another excellent point. Vanguard's participation is particularly interesting. For decades, they built their reputation on passive investing, offering low-cost index funds that track the overall market. This alliance signals a shift in strategy, acknowledging that even the most disciplined saver might want some exposure to potentially higher growth opportunities. But here's the rub. Private equity fees are notoriously high. Unlike those ultra-low expense ratios you get with Vanguard's index funds, where you might pay 0.1% per year, private equity firms typically charge 2 and 20, a 2% management fee on assets under management asterisk plus asterisk 20% of any profits generated above a certain benchmark. That adds up quickly. So while Vanguard is bringing its expertise in fund distribution and client service, they're also aligning themselves with an industry that isn't known for its affordability. It's almost like a superhero teaming up with a supervillain strategically, of course. And you know what this reminds me of? Remember when Netflix started offering DVD rentals by mail? They disrupted Blockbuster. Then they moved into streaming and disrupted themselves asterisk again asterisk. This is a similar kind of disruption playing out in the investment world. Traditional asset managers are being forced to adapt or risk becoming obsolete. It's a fascinating time, truly.
Wow, okay. This has been incredibly enlightening, Emma. So essentially, it's a gamble, potentially higher rewards, but with more risk, less liquidity, and higher fees. And Vanguard is hedging its bets by getting in on the action. Even though it kind of goes against their core principles, it's like they're trying to have their cake and eat it too.
Precisely. You've captured it perfectly. It's a calculated risk. And whether it pays off remains to be seen. But one thing is certain. The lines between public and private investing are blurring, and individual investors need to understand these changes if they want to navigate this new landscape successfully. And remember, knowledge is power, especially when dealing with your hard-earned money. This is why I've always said investing isn't about picking winners and losers, it's about understanding the game. Now, let's hope we haven't scared anyone off entirely. Haha. Right. Welcome everyone to what I'm tentatively calling democratizing Wall Street. A look at Blackstone, Vanguard and Wellington's new alliance. Now, isn't that a catchy title? Haha, it sounds like something ripped straight from a financial thriller novel. But seriously, this collaboration between these three giants, Blackstone, Wellington and Vanguard, is huge asterisk. We're talking about $12 trillion in assets under management, deciding to, well, let's just say, shake up the investment world as we know it. The core idea, bringing private equity, traditionally the domain of pension funds, endowments and very wealthy individuals, to the masses. Now, you might be thinking, okay Emma, that asterisk sounds good on paper, and honestly it is a fascinating development. But this brings us right to the heart of your question: should private equity truly be accessible to everyday investors? That's a loaded question. It's like asking if everyone should drive a Formula One car, technically possible, but probably not advisable for most.
Whoa, hold on. $12 trillion? That's a lot of zeros. And private equity, isn't that super risky? Like, what even asterisk is asterisk private equity anyway? I always thought it was something only Gordon Gekko types got into. Is this like they're trying to make us all miniature Gordon Geckos?
Chuckles. You're not wrong about the zeros. It's a number so large it's almost incomprehensible. And you hit on a key point. One risk, private equity, at its core, is investing in companies that aren't publicly traded on stock exchanges. Think of it as buying a piece of a business directly, or rather through a fund that does. It can be incredibly lucrative. The potential for higher returns is significantly greater than with public markets. Blackstone especially has built an empire on this very premise. But, and this is big asterisk, but, it's also illiquid. You can't just sell your stake whenever you feel like it like you can with a stock. It's kind of like buying into a family business. Your returns are tied to the success of that single entity. If the company thrives, great, you benefit handsomely. But if it stumbles, well, let's just say you might be holding on to an investment for long time. Now imagine scaling that up with many different companies and investments.
Okay. So illiquid means I can't easily get my money back out. That sounds scary. Is it like when I tried to sell my Beanie Baby collection in the 90s and nobody wanted them? Haha. Seriously though, if I need cash suddenly, am I stuck?
Laughing. Oh, the Beanie Babies. A painful lesson for many. A true testament to speculative bubbles. Yes, you've hit on something crucial. Illiquidity is a massive consideration. With stocks and bonds, there's generally a market maker ready to buy from you at any given moment, although price fluctuations are always in play, of course. Private equity doesn't have that same mechanism. You typically commit capital for 10 to 12 years. You might get some distributions along the way as investments are sold, but you can't just cash out on a whim. That's where these firms, Blackstone, Wellington, and Vanguard, are trying to innovate. They're attempting to create products that offer exposure to private equity, with more liquidity or at least better structuring. Think of it like offering fractional shares of a vineyard. You get the potential benefits of owning a piece of a winery, without having to buy the entire thing and deal with all the headaches of grape harvesting.
Fractional vineyards? That's surprisingly appealing. Okay, so Vanguard is known for low-cost index funds. Wellington has the active management expertise. And Blackstone, they're the private equity gurus, right? What does each one bring to the table that makes this alliance work? It sounds like a superhero team-up.
Precisely. A financial Avengers, if you will. You've got it exactly right. Vanguard's strength is democratizing investing through low costs and broad market access. They have millions of retail investors who trust them implicitly. Wellington brings decades of experience in asset allocation, knowing where to put your money based on the economic landscape. And Blackstone, While Blackstone has mastered the art of finding, improving, and selling private companies for a profit, John Gray at Blackstone is particularly astute in me. He recognized that demand for these types of investments from retail investors was increasing significantly. He's been strategically opening up access to their funds over the past decade. They've had some successes with business development companies (BDCs), which are publicly traded but invest in private companies. But this alliance takes it a step further, aiming for broader diversification and more sophisticated portfolio construction. Now let me tell you a little story. Back in the early 2000s, I was talking to a very seasoned investor, a friend of Charlie Munger actually, who ran a family office. He told me that the real money wasn't made in the stock market anymore, it was being made in private deals. The smart money was flowing into things like leveraged buyouts and venture capital. At the time it seemed almost elitist, but he was right. The returns from private equity have consistently outperformed public markets over the long term.
Whoa! So this has been brewing for a while then. It's not just some sudden trend. That's fascinating. Okay, but going back to the everyday investor part, I still feel like most people don't have the knowledge or stomach for this kind of risk. Like my Aunt Mildred, she barely understands her 401k and mostly just asks if it involves computers.
Chuckles? Oh, Aunt Mildreds are everywhere. You're absolutely right to be skeptical. And that's where the biggest challenge lies. This isn't about turning everyone into sophisticated investors overnight. It's about creating products that manage that risk and complexity for them. That could involve things like diversified portfolios, spreading your investment across many different private equity funds, or using a lower allocation to private equity overall. But here's the thing. Even with these safeguards, there's still an inherent level of risk involved. Private equity is not for the faint of heart. It requires a long-term perspective and a tolerance for volatility, and frankly many investors simply don't have that. This whole initiative also relies heavily on financial advisors being able to educate their clients properly about these products, something I'm not entirely sure is happening consistently right now. It reminds me of the housing boom in the 2000s. Everyone was getting into real estate, even people who couldn't afford it or didn't understand the risks. We all saw how that ended. This could be a similar situation if not approached responsibly.
Oh gosh. Don't remind me of 2008. That was not fun. So what do you think will happen? Will this actually work? Will Aunt Mildred end up accidentally investing her life savings in a tech startup that folds in 6 months? Haha.
Smiling, hopefully not Aunt Mildred's life savings. But it's a legitimate concern. I think this alliance has the potential to be successful, but it will depend on several factors. First, transparency is key. Investors need to understand exactly what they are investing in, and the associated risks. Second, fees need to be reasonable. Private equity funds typically charge higher fees than traditional investments, so Vanguard's low-cost approach could be a game-changer there. And third, and this is perhaps the most important, education. Education. It'll take time. This isn't an overnight revolution. It's more like a slow evolution in how we think about investing. I suspect we will see a tiered system emerge, with different products tailored to different levels of risk tolerance and sophistication. Maybe a private equity light for the Mildreds of the world. Haha. And perhaps something more complex for those who are willing to take on greater risks for potentially higher rewards. Ultimately, this move is about recognizing that the investment landscape is changing. The traditional 60-40 stock-bond portfolio may no longer be sufficient in a low-interest rate environment. Investors need access to new sources of return, and private equity offers just that if approached carefully. And honestly, it's a fascinating time to watch it all unfold. right. Welcome everyone to what I'm tentatively calling democratizing the deal room. Is private equity for everyone. A bit clickbaity perhaps. Haha, but seriously, this news about Blackstone Wellington and Vanguard teaming up is huge asterisk. It's not just another asset management shuffle, it's a fundamental shift in how everyday investors might access what was previously the exclusive domain of pension funds, endowments, and ultra-high net worth individuals, private equity. Now you see these big names throwing their weight around together, it always makes me think back to the late 90s tech boom. Everyone was rushing into .coms convinced they'd get rich quick, and look how that asterisk turned out for many. This feels a little similar. The promise of higher returns can be awfully seductive, and that's precisely what this partnership is dangling.
Higher returns. Okay, that sounds good. But you mentioned illiquidity. What exactly is illiquidity? Is that like when your favorite stock suddenly drops and you can't sell it without losing a ton of money? Because I felt that with the meme stocks last year, GameStop, AMC, it was wild.
Chuckles. Oh, honey, you've touched upon something crucial. Illiquidity isn't just about price drops. It's about access. Think of it like this. You have a beautiful antique vase. You know it's worth something, maybe even quite a bit. But finding the right buyer who appreciates it and is willing to pay your price, that can take time. Sometimes a lot of time. Public markets, stocks, bonds, are like a giant flea market, where buyers and sellers are always present. Private equity, on the other hand, is more like an exclusive auction house. You're investing in things that aren't traded daily, or even monthly. Think companies that haven't gone public yet, real estate deals locked up for years, infrastructure projects. Getting your money out can be tricky.
Ooh, so you're stuck with the vase until someone wants it. That sounds scary. But Blackstone is involved, right? You said they're good at this private market stuff? I feel like I keep hearing their name everywhere now. It's kind of like when Starbucks started putting their logo on everything.
Laughs heartily. A very astute observation about the Starbucksification of branding. And yes, Blackstone is a behemoth in the private equity world. John Gray, their COO, is a smart cookie. He understands the appeal to the masses. They've already been making inroads with individual investors through products like BDCs, business development companies, which are essentially publicly traded ways to access private debt. But this partnership, this is different. This is about building portfolios of private assets, alongside traditional stocks and bonds, packaged in a way that Vanguard, known for its low-cost index funds, can distribute widely. It's about scale, see? They are aiming to bring the benefits of diversification to people who wouldn't normally have access.
Okay, so it sounds like they're trying to make private equity less exclusive, like taking a fancy restaurant and opening up a food truck version. But why is everyone suddenly so obsessed with private assets anyway? Aren't stocks good enough? I thought Peter Lynch always said invest in what you know, and I definitely don't know about unlisted companies.
Excellent question. And Lynch did say that. A timeless principle, truly. But the landscape has changed. For years now, returns in public markets have been, well, let's just say modest, compared to historical averages. Everyone is chasing yield, right? Private equity theoretically offers access to faster growing companies, opportunities for operational improvements, and less correlation with the stock market, meaning it should behave differently when stocks are tumbling. Think of a company needing capital to expand. They might go private, restructure under new ownership, improve efficiency, and then potentially return to the public market years later at a higher valuation. That's where the higher returns come from. It's like taking a rough diamond and polishing it, but uh-oh.
Uh-oh? What kind of uh-oh? Is it something about fees? because I always feel like there are hidden fees everywhere. My gym membership is one big hidden fee situation. They charge extra for everything.
Smiling. You're a shrewd negotiator, I can tell. And yes, fees are absolutely part of the uh-oh. Private equity firms typically charge what's called a 2 and 20 inches structure, 2% management fee asterisk and asterisk 20% of any profits. That's significantly higher than the expense ratios you pay for a typical index fund from Vanguard, which might be say 0.05%. So, while the potential returns are higher in private equity, you need those investments to perform exceptionally well just to break even with public markets after fees. It's like you're paying a premium for the potential of a bigger cake, but if the baker isn't very good, you end up with crumbs.
Crumbs. That's not a good image. So this whole thing feels complicated? Is it really worth all the added risk and fees for the average investor? Maybe I should just stick to my index funds and avoid the fancy vase auctions. Haha.
That's precisely the debate. And it's why the emphasis on higher returns is so fraught with peril. For sophisticated investors, those who truly understand the risks, can tolerate illiquidity, and have a long-term investment horizon, private equity can be a valuable part of a diversified portfolio. But for the average investor, well, they need to tread very carefully. These firms are essentially trying to solve a problem they helped create by offering increasingly complex products. It's a bit like inventing a cure for overspending by offering a platinum credit card. Remember what Charlie Munger always said, it's remarkably easy to get into trouble creating and selling financial assets. That rings very true here. And it reminds me of the collateralized debt obligation CDOs before the 2008 crisis. Complex opaque instruments packaged as safe investments that ultimately blew up in everyone's face. Not saying this is bad, but the parallels are worth considering. Alright. Welcome everyone to what I like to call Decoding the Financial Frontier. Today's topic. It's a fascinating one. This alliance between Blackstone, Wellington, and Vanguard. Honestly, it feels like watching titans collaborate. We're calling today's episode The Great Convergence, when Wall Street giants unlock private markets for everyone. Now I've seen a lot of cycles in my time, the dot-com bubble, the 08 crisis, you name it. And what always strikes me is how access dictates opportunity. For decades the really juicy returns, the stuff that separates good investing from great investing, has been locked away in private markets, private equity, real estate, infrastructure. It's been largely reserved for pension funds, endowments, and the ultra-wealthy. But this changes things. This alliance is fundamentally about democratizing access to those returns. Blackstone bringing their expertise in alternative investments, they are huge in this space, you know. Wellington with its active management prowess, and Vanguard practically invented low-cost index investing. It's quite the lineup, isn't it?
Wow. That asterisk is a big deal. So, private markets were only for the rich before? Like if you weren't part of the in crowd with millions to invest, you just missed out on all the good stuff? That seems unfair. Seriously? How much good stuff are we talking about here? I always thought investing was about picking stocks and hoping they went up.
Haha. Oh honey, that's just scratching the surface. It is a bit unfair. Yes, think of it like this. You know those incredible restaurants with no reservations accepted, tiny hidden entrances, and a menu only revealed to regulars? Private markets are similar. They offer opportunities for higher returns because they're less liquid, meaning harder to quickly buy and sell, and often involve more complex investments. We're talking about things like funding a new tech startup before it goes public, private equity buying a shopping mall or apartment building real estate, or investing in toll roads and airports infrastructure. Let me give you an example. I remember back in the early 90s, a friend of mine, a very astute lawyer, not necessarily a financier, had the chance to invest in a small software company called Microsoft before its IPO. He didn't take it, said it was too risky, too complicated. Can you imagine? That's the kind of upside private markets offer. Now, that's an extreme example, obviously, but it illustrates the potential. The returns are often uncorrelated to public market swings, meaning when stocks are down, these investments can still be doing well, which adds diversification.
Okay. I think I'm starting to get it. So, less risk overall because it doesn't move with everything else. But you mentioned higher fees earlier, and that brings me to the core of your question, right? Is all this extra potential worth paying more for, especially when Vanguard is known for being so cheap with its index funds? Like I feel like if Warren Buffett were here, he'd just say keep costs low.
You are spot on . That's the million-dollar question, isn't it? And Buffett and Munger would absolutely be nodding in agreement about cost control. Now, let's unpack this active versus passive debate. It's been raging for decades. The core argument is that consistently beating the market through active management, picking winners, timing entries and exits is incredibly difficult. Most actively managed funds underperform their benchmark index over long periods, especially after fees are taken into account. It's like trying to predict the weather accurately a month out. You can get lucky sometimes, but consistently being right, very tough. Index funds, on the other hand, simply aim to replicate market returns at a very low cost. They're essentially saying, the market is efficient enough that trying to beat it is a waste of time and money. Vanguard pioneered this approach, making it accessible to everyone. It was revolutionary.
Right. I've heard about index funds. Buy everything in the S&P 500 or whatever, and just hold on. Sounds kinda boring though. Like, where's the fun in that? Is there any reason to bother with active management, then if most people can't beat the market?
Haha. Fun isn't always the goal of investing, darling. Though I do admit, it's more exciting to talk about a hot stock tip than an index fund. But seriously, there are asterisk reasons. Firstly, skilled active managers, and Wellington is one of them. Asterisk can add value through insightful analysis and strategic allocation. They can identify undervalued companies or sectors that the market has overlooked. Secondly, as we discussed, private markets offer a different risk-return profile than public markets. Now here's where this alliance gets really interesting. By combining Wellington's active management skills with Blackstone's access to private markets and Vanguard's distribution expertise getting these products into the hands of investors at a reasonable cost, they're trying to create something new, diversified portfolios that incorporate the best of both worlds. This isn't about chasing home run returns, it's about building robust, well-balanced portfolios designed for long-term success. I remember back in the late 90s when everyone was rushing into tech stocks and ignoring value investing. A friend of mine, a brilliant accountant, kept telling me that diversification and a focus on fundamentals were key. He wasn't making headlines, but he consistently outperformed the market over the long run because he didn't get caught up in the hype. That's what this collaboration aims for, a balanced approach.
Okay. So, it's like they're trying to give regular people access to a smart portfolio that isn't just asterisk stocks and bonds, but also cool private investments? And Vanguard is there to make sure the fees don't get out of control? That actually sounds pretty smart. But what about risk? I mean, private markets seem super complicated. What kind of risks are we talking about here?
Excellent question. Risk is always the first thing you should consider. Private markets definitely come with their own set of challenges. Liquidity is a big one. It can be difficult to sell your investment quickly if you need the money. Valuations are also less transparent than in public markets. Determining what something is actually worth isn't always straightforward. There's manager risk too, relying on Blackstone or other private market firms to make sound decisions. And let's not forget economic cycles. Private equity investments, for instance, often require significant debt financing. If the economy slows down, those companies can struggle to repay their loans. But these risks are manageable with proper due diligence and diversification, which is precisely why this alliance is so promising. They're bringing together expertise across all areas to mitigate these concerns. Think of it like building a house. You don't just throw up the walls and hope for the best, right? You need a solid foundation, asset allocation, careful planning, due diligence, skilled builders, fund managers, and a contingency plan for unexpected problems, risk management. That's what this partnership is aiming to provide, a well-constructed portfolio designed to weather any storm.
Wow. Okay. I think my brain just leveled up. It sounds like they're trying to build these super portfolios for people who don't have time or expertise to do it themselves, and making them accessible and affordable is the key. This whole thing makes me think of that meme. You know, the one with the distracted boyfriend, where he's walking with his girlfriend traditional investing, but looking longingly at another woman private markets.
Haha. Oh, absolutely. That's perfect asterisk analogy. The traditional approach is definitely being challenged. And this alliance feels like a pivotal moment, a shift in the landscape of asset management. It'll be fascinating to see how it unfolds, and whether they can deliver on their promise of democratizing access to institutional quality investments. But I, for one, am optimistic, because ultimately what we all want is financial security and opportunity, and that's what this collaboration aims to provide. All right. Welcome everyone to what I'm tentatively calling the Titans table. When Wall Street giants share a plate. A bit dramatic perhaps, but it reflects the sheer magnitude of this news. We're diving into this alliance between Blackstone, Wellington, and Vanguard, three behemoths managing a collective $12 trillion. Now, is this altruism or ambition? That's the asterisk question, isn't it? It's always a dance, you see. A very carefully choreographed dance with trillions of dollars at stake. I remember back in '87, right before the crash. Oh boy, that was a time. We saw similar partnerships forming, ostensibly to stabilize markets. Turned out some were just positioning themselves to weather the storm and perhaps even profit from it. So skepticism is healthy, but this feels different, at least on the surface. The core idea here is democratizing access to private equity. For years, decades, these incredible returns from private assets have been largely locked away for institutional investors, pension funds, endowments, sovereign wealth funds, the average Joe, while he was stuck with stocks and bonds. Now Blackstone has already made strides in opening up some of its funds to high net worth individuals, but this alliance aims to go further, bringing those opportunities to a much wider audience through these simplified multi-asset portfolios. It's like trying to get everyone a seat at the best restaurant in town, right? Historically, that restaurant had a velvet rope and a very strict dress code. This is about loosening things up.
Wow, $12 trillion. That's like all the avocados ever sold multiplied by 1 billion. Seriously though, private equity being inaccessible to normal investors has always seemed unfair. I mean, isn't that where all the real growth is happening? Everything I read says so. But if these firms are trying to be nice guys, why now? And why together? That feels unusual. Voltron. I love that analogy. Okay, so it's like they each have superpowers and combining them makes them unstoppable? But wouldn't making private equity accessible to everyone potentially inflate asset prices? If suddenly everyone's piling into these funds, aren't you just creating another bubble, like Beanie Babies or NFTs?
Oh, a brilliant question. Yes, that is a very real risk. It's the age-old problem of supply and demand. When demand exceeds supply, prices go up, and private equity valuations can be opaque, let's just say. Unlike publicly traded stocks with daily price discovery, private company values are typically assessed quarterly or even less frequently. This creates room for potential overvaluation if there's a flood of new capital chasing limited opportunities. And you brought up Beanie Babies and NFTs, excellent examples. It reminds me of the dot-com boom in the late 90s. Everyone was throwing money at anything with .com attached to it regardless of fundamentals. This is where due diligence becomes critical. These firms should be exercising rigorous selection criteria for the private assets they include in these portfolios. But even then, there's no guarantee. The potential for inflated valuations is definitely there, and will depend on how carefully they manage capital flows into these new products. However, remember that Blackstone, Wellington, and Vanguard are not dummies. They're sophisticated investors with a strong incentive to maintain market integrity, at least to some extent. A bursting bubble isn't good for anyone, even them. It also creates opportunity for other firms to swoop in.
Right, so they have a vested interest in not causing another financial crisis? That makes sense. Ish. But what about the average investor who doesn't really understand private equity? Like, I know it involves buying companies or parts of companies and trying to make them more profitable. But what are the risks beyond just overpaying for something? What if a company they invest in goes belly up?
Excellent point. The lack of liquidity is perhaps the biggest risk for individual investors. Unlike stocks, which you can sell relatively easily on an exchange, private equity investments are illiquid. You're locked in for years, often 10 or more. There's no easy exit strategy if you need your money back quickly. This means you need to be comfortable with tying up your capital for the long haul and weathering potential downturns. Furthermore, transparency is often limited. You won't have the same level of disclosure about the underlying companies as you would with public stocks. It's harder to assess their financial health and performance. And yes, companies do fail. Private equity isn't immune to bankruptcy or poor management decisions. I remember a fund I consulted on back in the early 2000s that invested heavily in telecom startups right before the bubble burst. A lot of very promising companies went poof. It was a harsh lesson in diversification and risk management. Investors need to understand that private equity is not a guaranteed home run. It's higher risk, higher reward, but with those rewards come significant potential downsides. These firms have to do a good job educating investors about these risks.
Okay. So illiquidity, limited transparency, and the possibility of losing all your money. Sounds fun. Haha. No. But seriously, it seems like this alliance needs to be really careful about how they market these products. They can't just say private equity equals riches, without explaining the downsides in detail. Otherwise, it feels kind of predatory, right?
Predatory is a strong word. But you're absolutely right. Transparency and responsible marketing are paramount. It would be irresponsible, and ultimately self-defeating then, to lure investors into these products with unrealistic promises. The regulatory scrutiny will also be intense. The SEC will be watching closely to ensure that investors are adequately informed and protected. Now, I'm a bit of a cynic when it comes to regulation. Sometimes it feels like locking the barn door after the horse has bolted. But in this case, I think there will be genuine pressure to get it right. Too much damage could be done if these products are missold or lead to significant investor losses. Ultimately, whether this alliance is a triumph of financial innovation or just another example of Wall Street greed remains to be seen. But one thing is certain, it's a game changer for the asset management industry, and has the potential to reshape how millions of investors access private markets. And I, for one, am very curious, and slightly apprehensive to see how this all unfolds. We'll definitely be keeping a close eye on it here at the Titans table. Right. Welcome everyone to what I'm tentatively calling the Titans Team Up. Decoding the Blackstone Vanguard Wellington Alliance. Haha, a little dramatic perhaps. But honestly, this is huge. We're talking about $12 trillion under management. That's more than the GDP of most countries. And they're all shaking hands to bring private equity and other alternative investments to, well, the average investor. It sounds fantastic on paper, doesn't it? But like anything involving enormous sums of money, we need to dig a little deeper. Now, you brought up a critical point right away. Conflict of interest. That is absolutely the first thing I thought of.
Whoa, $12 trillion? That's just numbers flying at me right now. Okay, so private equity is usually for really rich people, right? Like the 1%ers who have yachts and stuff? And these guys are trying to let asterisk us asterisk in on it? What's the catch? And conflict of interest, how does that even work here? I mean, aren't they supposed to be looking out for us?
Exactly. You're hitting all the right notes. Historically, private equity, think buying companies, fixing them up and selling them for a profit, has been incredibly exclusive. High minimum investments, long lockup periods. It wasn't designed for your everyday 401k. Blackstone, in particular, has made strides to open this up, with products like their BREIT fund, but now you've got Wellington and Vanguard joining the party. Now a conflict of interest arises because these firms make money based on assets under management, AUM as we call it. The bigger the funds they manage, the more fees they collect. So there's an inherent incentive to grow those funds, even if every single investment isn't perfectly suited for every investor. It's like a doctor who gets paid more for prescribing a certain medication, even if another might be better for you.
Oh, okay, I think I'm following. So they get richer the more money people give them, so maybe they'll push these investments even if it's not the best choice. That sounds kinda shady, honestly. Is that illegal? And wait, Brie? Didn't I hear something about that being troubled?
Shady isn't necessarily illegal, but ethically questionable is definitely in play. It's a classic agency problem. Whose interests are they serving? Now you have excellent memory. Yes, BRIT, Blackstone Real Estate Income Trust, did face redemption requests that led them to limit withdrawals last year. That was partly because interest rates rose rapidly and the value of their real estate holdings didn't keep pace. This highlighted a key risk with private investments: they're illiquid. You can't just sell your stake in a private equity fund on a Tuesday afternoon if you need cash. Unlike stocks which trade freely on exchanges, it's like trying to sell your grandmother's antique vase quickly. You might have to take a hefty discount.
Whoa, okay, that's scary. So I could get stuck in this investment and not be able to get my money out when I need it. Like, what if I lose my job or something? That doesn't sound very accessible at all. But these are huge companies. Surely they wouldn't let something like that happen again, right?
Well, that's the million-dollar question, isn't it? They they're building safeguards. The article mentions this is about creating easy-to-access investment solutions, but easy access doesn't equate to risk-free. These firms are trying to navigate a tricky balance between making private markets available and protecting investors from the inherent risks involved. Remember the dot-com bubble? Everyone wanted in on internet stocks regardless of valuation. Then, poof, that didn't end well for many. This feels somewhat similar. There's a lot of hype around potentially higher returns in private markets, but it comes with added complexity and risk.
Okay, so higher returns, bigger risks. Gotcha. But the article also mentions Wellington Management being good at active management and Vanguard having low-cost index funds. How do those fit into all this? Is it like a superhero team where everyone has special powers?
Haha, that's actually a pretty apt analogy, you know? It is a bit of a superhero team-up. Wellington brings their expertise in actively managing money, trying to beat the market by picking winning stocks and bonds. They've been doing this for decades, so they have a strong track record. Vanguard, on the other hand, is known for its index funds, passively tracking the overall market at very low cost. Think of it like this. Wellington tries to be the race car driver who overtakes everyone else. Vanguard is happy to ride in the well-maintained vehicle that consistently keeps pace with the pack. They both have value. Combining those strengths, along with Blackstone's private market prowess, could create genuinely diversified portfolios. The idea is to offer something for every investor, from conservative to aggressive.
Okay. So like a choose-your-own-adventure portfolio? That actually sounds kinda cool. But going back to the conflict of interest thing, even with these different strengths, can they really put my interests first, if there's so much money involved? I'm still worried about them pushing something on me that benefits them more than it benefits me, like a sneaky upsell at a car dealership.
You are absolutely right to be skeptical, and you have a very healthy dose of investor cynicism, which is excellent. That's why due diligence is crucial. Investors need to understand exactly what they're getting into, the fees, the risks, the liquidity constraints. This alliance could genuinely democratize access to potentially lucrative investments, but it also creates a powerful entity with significant incentives that might not always align perfectly with individual investor needs. It reminds me of J.P. Morgan's famous quote, "A man who cannot honestly differ from others will never do anything original." You need to be able to question everything, especially when large sums of money are involved. This isn't a set it and forget it kind of situation, folks. It requires active monitoring and understanding. Right, welcome everyone to what I'm tentatively calling the velvet rope of finance. Because honestly, that's what this whole thing feels like. We're diving deep today into a fascinating and frankly, potentially thorny issue. This article about Blackstone, Wellington, and Vanguard teaming up, it's not just news, it's a seismic shift in how investments are structured. They're trying to open the doors to private markets for everyday investors. Which sounds lovely, doesn't it? But I want us to really unpack this because accessibility isn't always equitable, and that leads directly into your question: to what extent does increased access to private markets exacerbate existing wealth inequality? It's a huge asterisk question, honestly. It's like offering everyone a seat at the caviar table, but forgetting most people can't even afford the crackers to go with it. Now, I've seen cycles come and go. Remember the dot-com bubble? Everyone thought they were going to be overnight millionaires. Then 2008? Oh boy, that was a doozy. You learn something from every crash, you really do. And what I learned is this: access to opportunity isn't enough. You need knowledge and often more importantly the capital to even participate in the first place. These firms, Blackstone especially, have built empires managing money for institutions, pension funds, endowments, the very wealthy. Private equity, private credit, infrastructure. These investments typically require massive minimums, think 7 figures, and they're illiquid. You can't just sell them off on a whim like stocks. Now, Blackstone has been slowly opening up some of these to high net worth individuals for a while now, but this partnership with Wellington and Vanguard, that's different. That aims to scale it down even further, potentially reaching the mass affluent, those who have a decent amount invested but aren't billionaires.
Whoa! Okay, this is already getting complicated. So, let me try and get this straight. Private markets are usually only for really rich people and big institutions. And these 3 firms want to democratize it. Is that the word? But you're saying that even if they make it accessible, it might not actually help everyone equally. That sounds frustrating. It's kind of like when they started making organic food available in regular grocery stores. It was great for people who could afford the premium price, but didn't really change things for those on a tight budget, right?
Precisely, you hit the nail on the head with that analogy. Democratize is often used, and it's generous. Let's be real, it's expanding access, yes, but it doesn't eliminate the hurdles. The biggest hurdle is upfront capital. Even if they lower minimum investment amounts, say to $50,000 or even $25,000, that's still a substantial sum for many families. That money could be used for a down payment on a house, paying off debt, education, essential things. And then there's the knowledge gap. These aren't simple investments. You need to understand how private equity works, the concept of limited partnerships, carried interest, illiquidity. It's not something you learn in high school economics class, haha. It requires sophisticated financial literacy, which tends to be correlated with wealth and education. I remember when I first started out, a client came to me wanting to invest in timberland, a private asset. He had no idea what he was getting into, thought it was like buying stocks in a lumber company. We spent hours explaining the complexities of land management, harvesting cycles, environmental regulations. It's not passive investing, it's an active long-term commitment.
Okay, so even if someone has the money, they might not understand what they're buying. That makes sense. But wouldn't Vanguard, with their whole low-cost index fund thing, help with that? I mean, aren't they supposed to be the champions of the little guy? This is making me think about those crypto schemes my cousin keeps trying to get me into. He says it's the future, but I always feel like someone's getting rich off my confusion.
That's a very astute observation, and your cousin's situation perfectly illustrates the point. Vanguard is traditionally the champion of the little guy. They revolutionized investing with low-cost index funds, and they will undoubtedly bring that ethos to this partnership. However, even in their offerings there are different tiers. They're actively managed funds, while still lower cost than many competitors, require more sophistication to understand and potentially offer less predictable outcomes. This new initiative is venturing into a completely different realm. Private markets aren't like the public stock market where you have readily available information, analysts covering companies, daily price discovery. It's opaque. Valuations are often subjective, based on appraisals rather than real-time trading. And that opacity benefits those who already have experience and access to inside knowledge, which again tends to be the wealthy. Think of it like this. Imagine two people entering a poker game. One is a seasoned professional who's played for years, understands probabilities, can read tells, and the other is someone who's never even seen a poker table before. Vanguard might give both players a few extra chips, lower fees, but that doesn't level the playing field.
Oof. The poker analogy really hits home. So it feels like this whole thing could actually widen the gap between the haves and have-nots? Is there any way these firms can mitigate that risk? Like, could they offer robust educational resources or, I don't know, some kind of financial literacy training alongside the investments? And speaking of gaps widening, isn't it kinda ironic that Vanguard is involved? Didn't Jack Bogle, their founder, build the company on the idea of giving everyone access to market returns? It feels a little bit like going against his whole philosophy.
You are incredibly insightful. That's exactly the tension at play here. And yes, the irony of Vanguard's involvement is not lost on many. Jack Bogle was a true believer in broad-based investing, and he would likely have been skeptical of this venture into private markets for anything but the most qualified investors. Now, can they mitigate the risk? Absolutely. Robust financial education is crucial. They need to provide clear, unbiased information about the risks involved, the illiquidity, the lack of transparency, the potential for loss. They could even offer certification programs or workshops to help advisors better understand these investments and guide their clients appropriately. But I'll be honest, even with the best intentions, it's an uphill battle. There's a fundamental conflict of interest at play. These firms are incentivized to grow assets under management, meaning they want more people investing in their products. And that incentive doesn't always align with protecting investors from taking on risks they don't fully understand. It reminds me of the story of Icarus, who flew too close to the sun with wings made of wax. These firms are reaching for higher returns by venturing into private markets, but they need to be very careful not to get burned. And more importantly, not to lead their investors to a similar fate. The promise is there, but it will take discipline and a genuine commitment to investor education and protection to truly benefit everyone involved, not just the already wealthy.
Wow. Okay, this is intense. I mean, Blackstone, Vanguard, and Wellington all together? It feels like assembling the Avengers, but for finance. Haha, but you're right to point out the potential downside. I always picture private equity as these shadowy figures making big deals, and it doesn't always seem transparent. So if they're opening this up to everyone, how do we know they aren't just pushing their riskier investments onto us? Like, will my retirement fund suddenly be full of foreclosed homes or something? That's a little dramatic, I guess.
Dramatic but a valid concern. You're absolutely right to ask that. And it gets to the heart of this whole ethical consideration piece. See, traditionally, these big institutions have sophisticated internal teams, due diligence experts, risk managers, legal counsel, who scrutinize every deal before investing. They can afford to kick the tires really thoroughly. Your average investor doesn't have that luxury, right? The assurance as they present it lies in a few layers. Firstly, the sheer size and reputation of these three firms. They need to maintain a certain level of integrity to continue operating. Secondly, there's likely going to be increased regulatory scrutiny. The SEC will be watching this very closely, I assure you. Thirdly, and this is where it gets tricky, they'll have to clearly disclose the risks involved in these private investments. But disclosing isn't enough. Disclosures can be dense, filled with legalese that nobody understands. That's why having a good financial advisor who truly understands your risk tolerance and investment goals is crucial. It's like, you wouldn't let just anyone perform surgery on you even if they gave you a detailed explanation of the procedure, would you? You'd want a qualified surgeon with a proven track record.
Okay, that's a really good analogy. I never thought about it like that. So, are they going to be forced to reveal all these shady dealings? Because Blackstone has had some headlines, especially about rent hikes and evictions during the pandemic, right? Like if they own a building with a history of tenant complaints, do they have to tell us before we invest in that fund? Or is it just like potential risks associated with real estate investment, which could mean anything. And, how does Vanguard fit into all this ethically? They're known for being super low cost and investor friendly. Doesn't partnering with Blackstone kind of tarnish that image?
You are asking the great questions, my dear. Exactly right about the rent hikes and evictions. Those were significant PR nightmares for Blackstone. And yes, they will likely be required to disclose material information, but the level of detail is where things get murky. It won't necessarily be a detailed dossier on every tenant dispute. They'll frame it in terms of potential operational challenges or market risk. It's all about carefully chosen language, believe me. I've seen enough prospectuses to fill an ocean. Now Vanguard, that is the interesting part of this equation. You are spot on. They built their reputation on being the champion of the little guy, offering incredibly low-cost index funds. Partnering with Blackstone is a bit of a departure for them, and it certainly raises eyebrows. But think about it from Vanguard's perspective. They're facing increasing competition. Fees are getting squeezed across the industry. To continue growing, they need to offer new products and services. Private market access is a huge growth opportunity. It's a calculated risk. They can leverage their brand trust to distribute these Blackstone-managed funds, while still maintaining some distance from the potentially controversial aspects of Blackstone's direct investments. It's like offering a premium coffee blend alongside your regular house brew. You attract a new customer segment without completely alienating your existing base.
Okay, I'm starting to see it. So Vanguard is kind of being used as the trustworthy face for this whole operation? That feels manipulative almost. But, if these funds are so risky, why would Blackstone even want to open them up to regular investors? Wouldn't that just create a lot of angry customers when things inevitably go wrong? It's like, imagine opening a casino to tourists who have never gambled before. You're pretty much guaranteeing some people will lose everything and complain.
Haha, that casino analogy is perfect asterisk. You are learning quickly. You're right to question that. Why invite potential backlash? Well, several reasons. Firstly, scale. The more capital they can deploy, the bigger deals they can do. Secondly, diversification of their investor base. Relying solely on institutional investors makes them vulnerable to large withdrawals during market downturns. Retail investors tend to be stickier, less prone to panic selling. And thirdly, and this is a big one, it's about fees. Private equity fees are significantly higher than those for traditional investments. Even a small percentage of assets from millions of individual investors can generate substantial revenue. Blackstone isn't necessarily trying to trick anyone, although transparency will always be a challenge. They are simply responding to market forces and optimizing their business model. It's not about malice, it's about maximizing profits. That said, the onus is on investors, to do your due diligence and understand exactly what you're getting into. This isn't a get-rich-quick scheme. Remember, if something sounds too good to be true, it probably is. I always tell people, there's a reason why those big institutions have historically kept these investments to themselves. It's not charity. They were protecting their own interests and the interests of their sophisticated clients.
Okay. Wow. This is making me really rethink my entire investment strategy. So, what should someone actually do if they're considering investing in one of these new portfolios? Besides getting a super smart financial advisor like you. Haha. Are there specific things we should be looking for in the fine print? Like red flags or warning signs?
Haha, always good to get a laugh. As for what to do, first, understand your own risk tolerance. Are you comfortable with the possibility of losing money? Private investments are illiquid, meaning you can't easily sell them when you need cash. They also tend to be more volatile than stocks and bonds. Second, scrutinize the fees. High fees can eat into your returns significantly. Look for clarity on exactly what you're paying for. Third, demand transparency. Ask about the underlying investments, the valuation methods used, and the track record of the fund managers. And finally, this is crucial, don't put all your eggs in one basket. Diversification is still key, even within a diversified portfolio. Don't allocate a disproportionate amount of your assets to private markets. Think of it as a small spice rack. You want a little bit of everything to add flavor, but you don't want to build your entire meal around paprika. This whole situation reminds me of the movie The Big Short. These firms are essentially packaging up complex financial instruments and selling them to a wider audience. Hopefully this time around, everyone involved will be more cautious and informed. But history has a way of rhyming, doesn't it? So tread carefully, my friend. Tread very carefully. And always remember, knowledge is power. Right. Welcome everyone to what I'm calling today the Great Leveling Up Private Equity for the People? A bit clickbaity perhaps. Haha, but it gets your attention, doesn't it? We're diving into this fascinating alliance between Blackstone, Wellington, and Vanguard. They're promising everyday investors access to the kind of investment portfolios previously reserved for massive institutions, pension funds, endowments, sovereign wealth funds, the big players. And that asterisk is asterisk a really big deal. I remember back in the early 80s, private equity was almost mythical to the average investor. You only heard whispers about it on Wall Street. Now these three giants are trying to democratize it.
Wow. Okay. But asterisk does asterisk sound huge? Blackstone, Vanguard, and Wellington. That's a lot of money under one umbrella. So like, my grandma could potentially invest in something like a private jet company through this. Is that what private markets even means?
Chuckles. Well, not necessarily asterisk directly asterisk in a private jet company, though it's not entirely off the table. Private markets essentially encompass investments in companies that aren't publicly traded on stock exchanges. Think real estate. Blackstone is massive in that space. Infrastructure projects like toll roads or airports, even businesses owned by other firms but not open to public trading. It's a whole world beyond Apple and Microsoft, right? They offer potentially higher returns because they are less liquid, meaning harder to sell quickly, and often involve more risk. And historically you needed to be an accredited investor with substantial net worth to even get a look in.
Okay.